and the issues over the southern border, and you've got to get everyone to agree on some of these issues early next year?
Our adversaries or potential competitors using this as an advantage, that there is a disagreement in the United States. That is one of the concerns. We hear Vladimir Putin talking about how he's essentially won. He has funds committed to this at a time when Ukraine is losing support from the U.S. as well as from European allies. You hear that over with the Houthi militants, right? If they do block passageway, at what point will the U.S. be willing to attack them because they don't want to get into a prolonged fight with Iran? It just is a tenuous moment with a lot of uncertainty about the U.S. response function in addition to what other actors are going to do.
Couldn't agree more. If you're looking for a quiet end to the year, Tom, I'd be looking down at Washington today. I'd like to know the response from the White House to that story that's just come out of the NBC. Did that happen? What's their view on it? And what did the president say back to the Chinese leader if he did indeed say that?
Well, and it's going to be folded right into the election. And you wonder if it's going to be a geopolitical election in November of next year. And the rule book says it doesn't play into it, but I really wonder if this time will be different. Right now is a joy. Christina Katmany joins us right now with Invesco for decades, or years, I should say. I don't want to date her that much. With years with Oppenheimer and Company. And just thrilled that she could join us today. Global Debt Senior Portfolio Manager at said Invesco. I love your note because you stay at 60,000 feet. How does a 60,000-foot macro view devolve down to what bonds and equities are doing now in this melt-up?
So I think the Fed last week painted a picture and has changed and is still the driver of global central bank policy. So when we look at the world, there's obviously all these different forces, but I think the Fed is still the big driver. And I think the Fed's message is, look, we're getting a lot closer to a soft landing, and maybe we've done it. So the policy mix that's gotten us there now has to be adjusted to keep us in this soft landing.
What's your average duration? Just roughly 7 years, 10 years? I'm just
shorter.
Shorter, 5 years, 3 years. Okay, whatever. That's not money market fund.
No.
And the answer is, at Invesco, how is the consensus on money market fund flows into that duration that you have, 5 years, say, or whatever?
So look, I think when we look at all of these markets, we're kind of priced for perfection, or even stretching it, as you said, we're pricing 150 basis points for the BOE for the Fed in terms of cuts for next year. Duration, I think everywhere feels a little stretched, but it's the same way that risk assets that looked rich kind of look rich still. I think the opportunities become in FX. The curve seems very out of whack. I think you should have a steepening bias in the US, but certainly everywhere, because you're getting a change in tone and a move towards easier policy.
All I can say is I want to talk about the whatever. The concept of what else you're buying other than money markets. Yeah, exactly. Yeah, she's like, no, Belly, whatever. It's not money market funds. What about longer term debt makes you concerned? Are you worried that we're not going back to a pre-pandemic world? And I ask this at a time when you do see inflation expectations coming down, and there is this feeling that the Fed is kind of declaring victory without declaring victory.
Yeah, so I think that's right. I think that the Fed, and it's interesting because we've had all of these Fed speakers in the wake of Powell that are all trying to push back, and the market is not listening or paying too much attention. But I think it's hard to look at Powell's performance on Fed Day. You had SEP, the statement, and the press conference itself, and everyone seemed to lean aggressively dovish, and I think it was a clear message. Like, I don't think anyone's looking back and saying, oh, we need to walk this back. I think there will always be pushback because we go in the swings, but I think you've taken out the tails both sides. And when you look at inflation expectations are coming down, but it's been very impressive how much inflation markets the entire time, even when we were running high single-digit inflation numbers in the US, TIPS markets were very well behaved. Expectations in the markets said, we believe that the Fed can do this, right? Much to a lot of participants' dismay of, is inflation, is it sticky or is it not? And I think you guys keep coming back to this. Maybe it really was transitory and it's just a longer transitory, and the Fed is now having some comfort with that.
Well, do you buy into that? I mean, in other words, you say that it looks rich on the long end, but why not buy 10-year Treasury yields if you think that it was transitory and we're going back to where we were before?
So I think you have a lot of supply that needs to come, and I think some of the dynamic here, I think it's less of an inflation story and more of a curve story from here. Or excuse me, less of a duration story, more of a curve story from here. And should the curve probably normalize in both ways, that we should have higher long end rates because you have to price in premium from fiscal and supply. And I think with the Fed taking its foot off the brake sooner, what it tells you is there's the risk that inflation reemerges at some point, because they're saying if inflation has come down, labor market has slowed a bit without massive job losses, so we want to normalize a bit, but I think that leaves you with risk that inflation can be higher. So I think you need to have that term premium. But I think duration itself and what we've seen the last week is a flow story, is people chasing, it's into year end. I think there's a lot of like idiosyncratic things that are driving it short term.
It's been price up, yield down, but this after a 3-year bond carnage that none of us have ever lived. I guess you got to go through a resistance line to say it's a fixed income bull market. Have we gone through that resistance line, that trend line of gloom of 3 years? Have we broken out to new bond nirvana?
I think that, look, you've taken out the tail of the Fed needs to go to 6%, 7%. You've taken that tail out.
Okay. But then come to center tendency. Is it a bull market?
I think that's probably the backdrop. But again, from the levels that we are now, I don't think duration as a standalone in the U.S. in the long end is very exciting. I think there's emerging market, local market rates that are more interesting. I think there's other places that we find more value.
We've had a 1-year move in 2 months, Tom. I think it's easy to forget that. You don't just want to keep on moving with the market and saying, yeah, another 50 basis points. I look at the year-end outlooks for next year. We talked to Subhadra Rajappa of SocGen about this. She was looking for 375 on a 10-year. Sounds like a massive move when we're at 5%. Pull up the 10-year right now. Take a look at where the bond market is currently. Does 375 sound like a big move from where we are? So, Lisa, you put out your outlook 2 months ago. End of October, you're sitting around with the team. You see 5%. Yeah, you say 375. Then all of a sudden it gets to December. Where are we? 20th. We see 387. What are you going to do? Say, yeah, we're going to drop another 125 basis points. That's not how this works.
No, and then you have to talk about the potential volatility that has a full year baked into a 15 basis point move or a 10 basis point move. So you have to imagine that everyone's rewriting, and then you got Goldman Sachs just saying, forget it, it's just going to be higher next year.
50 something, 5K plus after looking for 4,700. When the outlooks came out, we said exactly this. 4,700 sounded bullish at the end of October.
Yep.
And now all of a sudden, you're looking at a down market if you've got a 4,700 year-end price target for 2024.
Futures, 4810.
There you go.
Right now.
We're like this far away from all-time highs. Christina, I feel for you. Christina Campmany there of Invesco. It's difficult to keep up. What are you going to do? Just keep redoing your year-end outlook for next year before we get to year-end this year?
Well, part of the issue is something did change, though. Not only the disinflation data, but the Fed and how they're going to respond to it. And that change, I think, was material enough for people to shift their outlooks. Mm-hmm. And so then they basically gave a green light to all the bulls out there. So why not get more bullish, right? And then do you have to worry about, the derivative effects of too much bullishness leads to bearishness? But
taking notes. I'm with you.
Notes.
Kind of,
If you're just joining us, please, by the way, at the moment at least, we're negative by 0.2%. We're just a little softer. We talked about this yesterday. I think it's worth bringing up again. 12 months ago, looking out 12 months. So what is the average call on Wall Street from strategists for the S&P 500? The question, where would we finish year-end 2023? The average, 4,000 points. 4,000. We are 20% above where people thought we would finish, Tom, year-end this year. How much weight should we put on year-end outlooks that were put out at the end of October, early November, when we've seen much of the move over the last 2 months?
They help you frame your belief, and you don't pull in their belief.
It also gives you a sense of where the balance is. And the idea that Amy Silverman said the potential risk is that things overshoot to the upside way more, and that blows people out of their positioning.
We've basically had everyone run from one side of the boat to the other. Like that.
Yeah, I like that. That's good.
Just like that.
Yeah.
Just like that.
Well said.
Thank you.
Well said.
Tom Porcelli, PGIM Fixed Income, next hour.
What do you worry most about your economy and Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is not an accidental infringement. This is a deliberate taking of our intellectual property. Apple's internal documents that we saw in court showed that they knew their product wasn't good enough to be used medically. There needs to be an honest dialogue. There needs to be an apology. These guys have been caught with their hands in the cookie jar, and instead of being embarrassed and doing the right thing, they're blaming everybody and they're fighting everybody.
But remember, you can buy the Apple Watch until Christmas Eve in stores. I love this story. I think it's brilliant. What a gift from the regulator that the ban comes in on Christmas Day. So you can carry on buying a watch until Christmas Eve. We're going to come back to that in a moment. That was the CEO of health technology company Massimo on his patent dispute with Apple over smartwatch technology. Apple also facing broadening bans of its iPhones in China. But Dan Ives of Wedbush remains bullish. He writes this: "We believe they will be the first $4 trillion market cap by the end of 2024, with a growing iPhone business into next year on the heels of what we view as a new tech bull market beginning. Apple is poised to have a strong year ahead, TK."
Interesting. And of course, he's been all over the media, but also he's been right. As I mentioned, Neil Dudd is maybe my economist of the year. On the sell side, getting a magnificent 7 right. Nobody's been as visible and articulate as Mr. Ives. He holds court at Wedbush. I want to go to the morning's valuation, where you give me a half-ass sum of the parts. You've got the service sector at the $1.5 trillion of $4 trillion, which is $257 per share. What's the total sum of the parts? Is it above 257, 12 months out?
Yeah, it's closer to 300 sum of the parts.
And you just can't go to 5 trillion because you don't want to, be inflammatory.
Well, the big thing is really the services is going to be the key over the next year. The re-rating that we're going to see in Apple, I think numbers moving higher, is going to be services driven. I think that's where the 1.5 to 1.6 trillion comes in. But I do think what's starting to happen now, despite what John thought in terms of like some of the China issues, you're now seeing unit growth come up, ASPs going up. To me right now, in Cupertino, they're popping the champagne, getting ready for a phenomenal year ahead.
Buried in the CFA is a barbell. And one is, are you running as a revenue growth story, or are you running as a profit-making story? To me, Apple's almost out of Graham, Dodd, and Cottle. They're running this thing for profit, right?
And that's how Cook, it's what Jobs did. It's how they've done it. But I think the difference, to your point, it's the monetization. The install base is unparalleled, 2 billion iOS devices. So now
half of them are in my house. Continue.
Exactly. And look, and you're one of the cross-selling opportunities for Cook. And the thing is that now what's starting to happen is that if you look at the services piece and you look at the penetration, the average Apple customer is still 20 to 25% penetrated from a services perspective. That's going to continue to up. And then I believe the big thing here is the AI app store that I think they introduce over the next year. That's going to be the new shiny object.
Okay, before we get to the new shiny object, let's talk about the old shiny object, the iPhone. If I told you where revenue was and where it would be at the start of the year for the end of the year, would you have said the stock was up 52% year to date?
Yeah, so what I'd say is that part has definitely been an upside surprise in terms of where the stock, I think the difference, it rests on the services business and what I believe is the margin story. So even though from a unit perspective, there have been some choppiness over the last quarter or two, if you look at the margins are up. I mean, so they've been able to expand gross margins in this environment, which I know we've talked about a lot of this on the show, but that just shows that they have control over their ecosystem from a chip perspective. That's been a key of the bulls.
You think they can go X growth but still retain a growth multiple?
I think this past year, they were able to go X growth and get the growth multiple. This next year, the renaissance of growth happens in Cupertino on services back double digits. Unit from an iPhone unit perspective continues to I'll say single digits. And the China story, despite all the worries, despite many yelling fire in a crowded theater, we're going to see China growth.
It's not exactly fire in a crowded theater when everyone keeps piling in, but I am wondering if you see growth coming mostly from the United States, or if that's international growth. Where does it come from in a pretty competitive landscape?
I think 70% of it's U.S. and Europe. 30% of the growth, the incremental growth, is in China. Because Lisa, if you look at today, 100 million iPhones in China have not been upgraded in 3 years. So even with Huawei and what we're seeing, the actual penetration, the upgrade opportunity, I'll call it essentially a mini super cycle that's playing out. Look, as of 24 hours ago, our Asia checks showing no cuts. And I think that's very important.
You know why I'm laughing? Because you said exactly the same thing 12 months ago, and it didn't happen. Where is this upgrade super cycle?
Okay, so now to that point, the upgrade cycle has, under the radar, been happening.
But at some point, don't you sit there and say that these phones haven't been upgraded for a reason, and then maybe they're not going to be upgraded?
But they would, and look, and I know it's a great point that you've brought up from an upgrade cycle. I think the difference is that the last 18 months, maybe the upgrades have been at a slower pace, but they've gained 100 million new iPhones in the last 18 months. So I think if maybe we've been right for the wrong reasons, whatever you want to call it, is like the upgrade opportunity, we admit, has definitely been a little more subdued this year than we would have expected. But on the upside, what we didn't expect is that the Android market share gains that they've gotten have been a flex the muscles moment.
There's no doubt you've been right. I just want to get into the reasoning about it. You know that, but you have been right. The stock is up by 52% year to date. I can't argue with that. Can we talk about the watch just briefly?
Yeah.
Telling Father Christmas he can't deliver presents on December 26th is not a big deal. I just wonder, the gift from the regulator, from your point of view, to turn around to Apple and say, can't sell the iWatch from December 25th. I mean, what does that actually do? What does that achieve?
When the red phone rings and it's Cook and Cupertino, that's...
You think that made a difference? Look, the fact this was Apple, you think that's actually made a difference to the regulator?
I think Apple just brings the different price, and we see it in terms of big tech, and it's one where even within Europe, and we see continue to come out of Brussels, and even in the U.S., there's a recognition where you don't want to poke the bear. Like, in other words, like, to actually do this in a holiday season, to go, let's say, December 15th, would have been much more drastic than obviously going Christmas Eve. But this is not ending. They're going to continue to have patent issues and battles on the healthcare front.
Are they really a proletariat issue, though, when they're charging $1,400 for an iPhone? I mean, is this sort of going to become an issue if margins are too big and they do get the nods from the regulators at a time of souring economic backdrop? Does that become a real pressure point of just how much those margins can keep expanding?
Look, I think margins continue to expand because from a chip perspective, they own their own ecosystem. And that's really been and Keen's talking about, that's a huge part of the opportunity in terms of just gaining more and more margins. But from a regulator perspective, I mean, look, I'm more focused on the cappuccino this morning than regulators in Europe because that continues to just be Noise, not real.
You sound like a man who's got stocks up 50% this year, that's for sure. Let's
Okay,
be clear.
and for radio, you're not getting the full joy of this because Dan Ives is dressed like a pinata this morning. You are the bear market pinata that's out there. They love going after you. And to me, the heart of the matter, and I'm going to go back to Graham, Dodd, and Cottle, EBITDA 2019, 29% margin. EBITDA right now, 33% margin. Where's that EBITDA margin in 4 years?
That's getting toward 40%. And I think
Really? You're going to give me an EBITDA of 40%?
I believe because as services becomes a bigger piece, the margins on that's double the hardware business. So as they further if you're a bull right now, you're not looking at next year. You look at the next 2-3 years. It's a cash flow machine. EBITDA is going to continue to expand.
40% margin on EBITDA?
When you look toward 2025, 2026, this is one where it's going to continue to move in that direction.
Okay, you've got 30 seconds. You're going to tell me now, what on earth is an AI app store? What is that?
There's going to be a separate app store in Apple. That's going to be health. It's going to be health, fitness, AI apps developers are going to build that Apple will have. It's going to be an offshoot of the App Store, an AI app store. And right now, it's all about developers. That's the hearts and lungs of Cupertino.
Right. The hearts and lungs is radio's not taking all this in. You got the Dayglow pink sneakers, the lime green, lime sorbet pants. You got the lavender thing going up top. He looks like a pinata.
You should punch back. He was wearing leopard print Doc Martens the other day.
Well, that's okay.
But I respected Doc Marten.
Leopard print?
Love it.
It's aggressive, but he could pull it off.
It's aggressive. It's aggressive. Dan Ives, congratulations, sir.
Fabulous
Fantastic
year.
year.
Home
You've been
run.
bullish. You were right to be. Thanks for being with us. Dan Ives of Wedbush. I think Lisa gave you a round of applause there.
Yeah, I
like
did.
a slow clap.
Yeah.
That was from a bear. So it's like a slow clap.
A little golf clap.
Yeah. Just like they sound like this. It's like, yeah, stocks are up.
Yeah, that's
No,
great.
25%.
Whoa, I
Bramo.
appreciate, appreciate.
Bramo, stocks are up 20%. Apple up 50. The Nasdaq still rallying. The banks
All
are
right,
up
are you
like
done yet?
25% in a couple of months.
Okay, all right, really?
Cameron Dawson in the next hour of New Edge. Daryl Cronk as well will break down the stock market for you. 2 hours away.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The Fed has told us they're not going to let this economy weaken in any material way.
There's a lot of chest thumping now and a lot of spiking the ball. Perhaps you'll see some Fed officials try to walk that back.
They're going to have to push back a little bit because it has been an absolutely enormous rally here.
The Fed's credibility in the end will rise and fall with delivering price stability.
There's a lot of room to go here. We're not out of the woods, and we have a lot of work to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, on radio, on CarPlay. Lisa has CarPlay in the Toyota 80 Series Land Cruiser. It's working out great for her. We say good morning on a Wednesday. Interesting economy here. Into the end of the year in the market. It's over. We're down. Futures are down 10. Lisa, it's over. Farrow's off. What, are you starting his shopping now? Is that what it is?
He couldn't take it after a couple minutes back with the pen. Here's the issue, is that we're looking at a market that is reaching toward new all-time highs. Yeah. And we're dealing with a broadening out at a time where nobody's pushing back. I have not heard one fund manager come on and say, I'm leaning hard against this, selling everything, going to cash. Not one person. Everyone's saying something changed.
And what has changed here, and I'm really serious about this, where we talk about international relations on Bloomberg Surveillance, it's front and center this morning. We were all learning the map of the Red Sea. James Trevita's helping out Bloomberg Opinion with his concerns about transport in the Red Sea. Maybe there's going to be a new transport, according to NBC and their discussions of Biden and Xi about that distance from Taiwan to China. There's a geopolitical overlay to this market that we're all ignoring because it's a melt-up.
Well, and there are some very specific read-throughs, and just taking the issue with respect to the Red Sea in particular, over 100 container ships have gotten rerouted already as a result of some of this conflict. You've seen insurance prices quintuple as a response to what we're seeing in terms of Houthi militants attacking a lot of different ships and naval passages going through there. So here is the question. How do you price this into a model that just assumes ongoing disinflation if supply chain disruptions could be the opposite?
And the other side of that is on the disinflation to go from geopolitical over to the wheelhouse of what we do here on finance and investment. At least it's real simple. The United Kingdom gave the gift that keeps on giving today was strong disinflation.
And that really has given an extra fuel to the bond market. The downside to this, and I will say, we were talking about FedEx earlier. They disappointed. Those shares lowered significantly. General Mills, under the radar, your breakfast cereal, if you're eating it right now, they came out and they actually downgraded their full year forecast. And you can see, even though those shares are down 18% already this year, those shares are being punished in pre-market trading, almost 4% down. So at this point, how much are the earnings surprises to the downside, the potential catalyst to some other type of move in markets?
We're going to keep this short this morning because we've got a sterling guest for Global Wall Street. Must listen in moments. Jim Caron will join us from Morgan Stanley. Lisa, look, futures at -10, Dow futures -75, a little bit of a pullback, but the VIX under 13. 12.67.
And this is being driven by the bond market. 10-year yields 3.88% if you round up, and they are down 5 basis points exactly because of what you said, the downside surprise in UK inflation.
The inflation-adjusted yield, which is what I look at and our next guest looks at, is 1.69%. It was a 2, and there was sweat on effect higher to 2.20, or even unimaginably high in this melt up, the inflation-adjusted yield, one measurement of our good feeling, has really come down. Jim Caron is expert at this, CIO of Portfolio Solutions Group at Morgan Stanley. You take the Christmas field, Jim, you talk about naughty or nice in the real yield. What is a level of the real yield that keeps asset inflation going?
So I think where the Fed wants to go with this, because what really matters is what they think. And I'm going to talk about the policy, the real policy yield. So this is a nominal Fed funds rate minus inflation. I think that number is around 1.5%. So it's lower than what it is today. Wow. So if we look at nominal Fed funds today at 5.5%, and let's say U.S. inflation is at 3%, that means real policy rates are at 2.5%, which means that the Fed could cut 100 basis points just to get to their neutral level. So I know we've been talking, I've listened on the show, that yes, there's like 6 rate cuts priced in, but remember 100 basis points of those rate cuts is really just getting to neutral.
Right.
And they don't start really easing until they start doing more than 100.
I did some fancy math, Jim, in honor of your attending today on the standard deviation move of the Bloomberg Financial Conditions Index. We've gone from accommodative, and this is not Stan Fisher 101, it's Tom Keene 101, we're grossly accommodative. How does a Fed, their degrees of freedom just seem to have shrunk because of the market's statement on accommodation.
Right. So when we look at financial conditions, this is really a way for the Fed to gauge how their monetary policy is impacting the broader markets, and there should be some feedback mechanism from markets to what their policy is actually saying. So the way that I think about this is that if the markets are rallying, that's okay with the Fed. The Fed doesn't have to push back on a rally because they don't like a rally. That's not their job. Effectively, what they're saying is, can we get this rally, and can inflation also stay low? And if the answer is yes to both, then they don't care if the market continues to rally. They don't feel as though they have to push back on that. And right now, the look through to inflation going forward, as you mentioned in the UK, we had a downside surprise in inflation. Inflation is coming down in the US. As long as it does, then the Fed is okay with higher equity prices, tighter credit spreads, and even easier financial conditions, as long as we don't get inflation starting to move higher.
Which is, let's park that for a second, this idea that disinflation, Goldilocks, this idea of the Fed just simply cutting rates surgically in order to keep in tandem with where inflation is going, and go to actually the fundamental economy and earnings. And I wonder how much that is the real risk that people are not talking about right now, given the fact that FedEx disappointed, shares lower by some 12% in early and pre-market trading. General Mills retracting some of their full-year forecast, downgrading it in response to lower sales, those shares falling even after an underwhelming performance. Is this the theme of January that people are missing?
So that's a really good question, Lisa, because effectively we have to think about the look through to this. If the unemployment rate starts to rise, because that's what we're talking about. When we're talking about earnings and missing earnings and things like this, what we're really saying, what an economist is really saying, is at what point do these companies start laying workers off, and at what point does that boost the unemployment rate? So what we're seeing at this point, at least the last data point in the unemployment rate has come down. The labor market still remains relatively tight, and it's relatively strong. Yes, it's softening. Yes, we are seeing signs of softening, but we're not seeing signs of a collapse. So ultimately, some of these things are going to be somewhat cyclical. Some companies are going to post worse earnings. Some companies are going to post better earnings. But if we look at the broad market, the story for December is actually not that these supercharged 7 stocks are doing really well in tech. The story for December is that the market's actually broadening out, is that the other sectors, the other 493 stocks out of the S&P 500, excluding those 7, are actually participating in the upside. So yes, it's not going to be a straight line. It's going to be volatile. But the point here is that missing earnings is one thing, and that could be cyclical, and I get that sector by sector. But as long as it doesn't affect hiring and wages and things like that to the degree that it creates a deeper downturn and loss of consumption, then that's just markets being markets.
It sounds like you're pretty bullish. Are you just telling clients to go all in, that basically their biggest risk is missing out on the upside next year?
No, I'm not saying that. Actually, one of the things that we've been bullish, we've been positive, we've been overweight in equities all year. And right now, towards the end of this year, we're starting to think about reducing that and moving towards neutral. We haven't done it yet, but that's probably our next step. And why that is because everything that we thought about in late October, November is actually already come through by the end of the year. So we've got this like 15% rally across the board in equities. We've got credit spreads a lot tighter. Bond yields, 10-year yields are below 4%. My gosh, my year-end forecast for the 10-year note, not that I make a forecast, but was around 4%, and we're already there. Right. So I think a lot of that good news has been pulled forward. So we need another catalyst to get higher. And I'd rather go to neutral, and I think neutral is the new defensive, so we can be tactical in the new year ahead, because there will be dislocations.
Jim, a cosmic question for those trying to recover from the bond debacle. You was negative 10 degrees at Bowdoin. You were studying physics. You go, oh, Caltech, that may be warm. So you go out to Caltech to get some decent weather in aeronautical engineering. Okay, great. Are these glide paths of stability, and do they indicate that dividend growth is a proxy for yield forward? That back and forth between your world of bonds and equities is a yield alternative. Can that be possible?
So I think it can be possible. I don't see it as highly probable. And the thing that I'm concerned about the most is that I do think that 2024 will be a very rocky year. So I know we're talking about these glide paths and soft landings. We may ultimately get a mild slowdown or a mild recession, which would be characterized as a soft landing. But I think it's a really dangerous landing at this point. And it's one of the reasons why I think that we need to engage in more of a balanced portfolio approach. So have some fixed income, have some equity, have some growth, have some value. And
just real quick, Jim, before we run out of time, what do you mean by dangerous landing?
So I think there's more geopolitical tensions and more geopolitical risks that are out there to start this year than last year. We have, obviously, China, Taiwan. We have Taiwan elections. We have a U.S. presidential election. I think that's going to create a lot of volatility. And I think the markets are, and don't forget, we have the 2025, the Trump tax cuts come due in 2025. At some point in 2024, we're going to start to price the outcome of that in. And that can swing the markets from an earnings perspective quite a bit, and from a multiple perspective. So I think let's just enjoy this calm right now, because I think it's going to get a lot rockier and a lot less, a lot more uncertain into the future.
Jim Caron, thank you. With Morgan Stanley there on your total return and ability to clip a coupon next year. Futures at negative 10, Dow futures negative 75, and the Standard & Poor's 500 were down 0.2%.
I love what he said there about the fact that he's thinking about going to neutral, and neutral is the new defensive, simply because the entire expectation for what was going to happen next year happened in a month. And that, I think, is really the key question for people who already wrote their outlooks. And now we're wondering, do we revise them, or do we just lean into them and say, it already happened, so now we're just going to bump up and down and try to figure out the new narrative heading into next year and end up pretty much the same place where we're beginning?
The narratives here have been humbled, and I'm going to go back to something I mentioned 2 hours ago, and this, folks, is where are we within the pandemic? And people go, oh, we're out of the pandemic. It's gone. And the tales of the stimulus, the tales of the good feeling for the financial haves. I mean, look, here's a headline in the last 24 hours. And I may be wrong, skewer me if I'm wrong. Homelessness is at a record high in the United States. Now, it's not 1937. It's not the panic of 1907 or 1870. But the answer is the financialization of all this has led to a pop from a stimulus, and that's what keeps us going.
And just to take it a step further, you're talking about homelessness. Let's talk about the generational divide, and we talk about that from a political standpoint, about how it's never been wider on a number of different metrics. How about this for a statistic? Americans over the age of 70 hold more than 30% of the country's wealth. And so you see that wealth disparity in a generational way, fueled in part by home ownership and a whole host of other things on the backs of a different interest rate regime. So a lot of things are under the surface here.
There's a lot of movement. I was talking to John Tucker in Bloomberg Radio the other day, and, he's popping his 201k is almost up to a 301k with recovery. He still can't retire. I mean, he's going to be here at 85. He's older than Charlie Powell.
I love when you troll random people and just to get a
it's
reaction
true. How
from
many
them
people
later.
out there can't retire? They're all looking at me. Stay with us. Futures rounded up. -10. Good morning.
Daybreak Europe, I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The Red Sea is a conduit for 10 to 15% of all global trade, 8% of global grain trade, and 12% of global seaborne oil trade. Bottom line is, these attacks have to stop. They need to stop. They're unacceptable. The United States, our allies, and our partners will do what we have to do to counter these threats and to protect these ships.
Pay attention to the Navy, and John Kirby is Admiral Kirby, and he's someone very different as a voice in Washington. Of course, U.S. National Security Council spokesman, and Admiral Kirby there talking about a geography that we think we know, but we don't know. It is the Red Sea from Suez in 1956 in the 1967 war closure down to the tensions. Now, Lisa, just extraordinary to see the suddenness of this. Suddenly, this matters.
And suddenly we have to think about what the willingness is to have another proxy war, another front to the proxy war with Iran that's basically being fought right now in the Gaza, in the Israel war, and how much this really is a willingness on the U.S.'s part to engage.
We're going to have to see on that. We're going to dive into it right now. Quick data check. Futures -10, Dow futures -73. Lisa noting yields coming in. Solid 5 basis points, maybe off United Kingdom disinflation. Do we say that oil's elevated? I mean, I got 69. I got American. I got Brent crude at $80 a barrel. There's a little bit of a movement there.
A little bit of a lift, but a lot of people are surprised that it isn't more, given the fact that 100 cargo ships have been rerouted as a result already of the conflict that we're seeing in the Red Sea.
What's going to be interesting here, and of course this goes back to his PhD, it's not those that talk, but those that do. One of the great doers in our international relations is Aaron David Miller. His thesis was Search for Security, centering on Saudi Arabia. He's senior fellow at the Carnegie Endowment for International Peace. Aaron, you have written about the stretch of sea, which to us is romantic, indeed biblical, the Red Sea. What is distinctive about the Red Sea in Yemen?
It's turned into a choke point, frankly. And you referred to the region's centrality in both the 56 wars, 67. You now have a situation in which an extremist, once ragtag militia, driven by ideology, the Houthis, now run by one of the founder's sons, Abdul Malik Houthi, has turned this organization into a significant threat. A proto-state which controls one Arab capital in Sana'a. The Houthis now control a part of the country which contains Yemen, which contains a third of the population of the entire nation. And rather than being sort of wholly owned subsidiaries by Iran, they are willing participants driven by ideology, a common affinity. They're both 12er Shia, just like the Iranians, inspired by the Iranian Revolution. They now, thanks to technology, now drones are being manufactured by the Houthis. They now have presented themselves as an actor, certainly now on the regional stage, and given Kirby's comment on the international as well.
The relation, Dr. Miller, the relationship of Saudi Arabia with some form of recent peace agreement with the Houthis, but I don't buy it for a minute, triangulate our interests with these rebels with Saudi Arabia and Riyadh.
Well, the Saudis right now do not want a major escalation, given the fact that Mohammed bin Salman's plans for 2030 have now been, in some respects, undermined by regional instability caused by the Israel-Hamas war. Saudis are trying to find a way to extricate themselves from Yemen. They fought the Houthis unsuccessfully. They may have actually energized the Houthi cause by any number of errant airstrikes, which killed hundreds, if not thousands, of Yemenis. So I think the Saudis don't want a U.S. escalation with the Houthis, and either do the Omanis, who are serving as a sort of bridge. Look, you look and see the maritime task force that Secretary Austin tried to assemble. You've got 7, 8 nations. The only regional nation that agreed to participate is Bahrain. And that's considered a sort of consolation prize, given their relationship with Saudi Arabia. So the Arab states seem very reluctant, as long as the Israeli-Gaza war goes on, to join in an American effort to suppress a group that is actually even more than Hezbollah, launching an actual short-range ballistic missile in Israel's direction. This is going to be a huge problem because our options here are not great. We can go through them if you want, but in terms of deterrence, we're already past that. But Houthis don't seem to be able to be deterred right now.
Aaron, what you just said there was fascinating, that the Middle Eastern allies traditionally with the United States are not getting involved because of the war between Israel and Hamas. Is this sort of Iran taking this opportunity to direct the Houthis to do this, to exploit the weakness, the lack of ties right now between Riyadh and Washington, D.C.?
I think that, yeah, I mean, some have argued that one of the key motivators of the Hamas terror surge on October 7 was a sort of pro-Iranian and pro-Hamas effort to undermine a relationship, Israel-Saudi-U.S., that could have created a whole new security architecture in the region. We're prepared, apparently, don't get me started on this, to basically conclude a mutual defense pact with Saudi Arabia in an effort to facilitate this normalization process. We haven't done that since we amended the U.S.-Japan Security Treaty in 1960. So, yeah, this was, I think, a part of Iran's calculation to chill that relationship that was emerging and ultimately undermine it. And the Houthis have the same motivation.
Which to me really raises this question, okay, how much does this add to the urgency of getting some resolution to the war between Israel and Hamas that seems to maybe be entering a new phase but doesn't seem close to a resolution?
It's an important point. It's now global trade, it's now supply chain, it's now Christmas. I mean, 10 to 15% of global trade through the Red Sea and Suez Canal. 3-week delay, and BP has already pulled their Red Sea operational trade from that region. You have to go around the Cape of Good Hope. That adds another 3 weeks to a month. I mean, this could, if it truly began to cause other private companies basically to pull out of the Red Sea trade, have a big impact. I just don't think it's going to affect either Israel's or Hamas's calculation. That's being driven by a whole different set of dynamics.
And David Miller, if we decide to become more offensive against these, whatever they are, terrorists, these Houthis, whatever you want to call them, Is that a decision of defense? Is that a decision of state in defense? State, is it decided at 1600 Pennsylvania? How do we change a thrust politically in Washington?
1600 Pennsylvania. I mean, the options, I'm told, are already on the table. You could have armed escorts, but we don't have enough warships. You could create a corridor with a sort of a anti-drone, anti-missile bubble above them. But remember, every time the Houthis launch a $2,000 drone, we respond with interceptors that cost $2 million. And the Pentagon is already concerned about the expense of waging war. I think the only real deterrence would be strikes against Houthi assets in Yemen.
Yeah.
And despite the fact that they've launched 38 drones and any number of missiles, we've just intercepted. I don't think there's a real drive on the part of the administration to go there, although it...
Good to leave it there. Aaron David Miller, thank you so much for the briefing with the Carnegie Endowment. Can't say enough about his writings over the recent decades as well. I have no idea how this falls into oil, but, you know, we go back to when we were kids and we were trying to imagine the boat going around the Cape of Good Hope versus sliding through the Suez Canal. And that's really, it's the same argument now it was when we were kids trying to figure out the maps and, you know, the seas and coming out of the Suez. That scene in Lawrence of Arabia where he's coming in off the dark desert, he's thirsty and all that. And you hear the ship's horn and the boat slides by. I mean, that's the romance of this, away from the risks that are involved.
I'm just still thinking about what Aaron David Miller said about why other Middle Eastern allies of the U.S. or traditional allies are not really weighing in or getting on board. And it's because they are still concerned about what's going on with Israel and Hamas. It shows how this is just a jigsaw puzzle coming together in a complicated soup of geopolitics right now.
Working fiercely in the surveillance control room. They're looking at LL Bean for last-minute shopping, but they're also adapting and adjusting to the news flow this morning. On China, on Taiwan, Michael Herson, 22V Research, that coming up in moments. From New York, this is Bloomberg Surveillance.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg Surveillance, we're going to get to it quickly here. John Farrow starting his Christmas shopping. Abramos here with me. We're waltzing through a Wednesday. Interesting markets and geopolitics as well. We're going to get to that in 2 seconds. Tom Perselli to come up with us with PGIM. But first, we're going to crowbar this in. We're thrilled to tear him away from Eurasia Group Writing. Joining us with 22V Research. 22V Research is Michael Herson, head of their China research this morning. Michael, were you surprised by the NBC report of a discussion between the two world leaders over the future of Taiwan?
No, not particularly surprised. It was consistent with what I heard from the meeting. I obviously wasn't there, so I can't speak to the details. But I think the notion that Xi Jinping is determined to pursue reunification with Taiwan is not new. I think in some ways it was equally as interesting that he told U.S. officials, according to this report, that there is no set timeline for China to do so. And I think that is consistent with the view that while this is a really important issue, Beijing continues to exercise what you could call strategic patience on this issue. And that's important because if that changes, it does, I think, increase the near-term risks around Taiwan. For now, I think those near-term risks are manageable.
There is this question around whether China is going to take an opportunity at a time where the U.S. is involved in a two-front proxy war with both Russia and Iran to try to engage in this more aggressively, since it's already difficult for the U.S. to commit exactly how much they're going to weigh in on these other conflicts.
I don't think we should dismiss those kinds of concerns. I mean, we need to be realistic about, not mirror imaging in terms of how China thinks that they're going to think about this the same way that we do. At the same time, I think we need to keep in mind there's a fundamental calculus at work for Beijing, which is right now it would be extremely risky, even with the U.S. tied down, so to speak, with other conflicts, to pursue reunification through military means. And I don't think that the urgency is there for China. I think Beijing continues to feel that time is on their side. Now, that timeline is not infinite, according to the report Xi Jinping stressed to President Biden. But I think the notion that Beijing would take this kind of gamble in the near term seems to me probably not worth it from the standpoint of China's leadership.
What is the motivation to try to take Taiwan at a time where there's some real clouds over the economic outlook for China, where they're trying to woo back U.S. And other international businesses, and where Xi Jinping is dealing with a host of issues around the housing market that are also challenging?
I think that's exactly right. I think if they made this kind of move now, it would basically be trading off all of Xi Jinping's broader ambitions for China in terms of economic development and its place in global leadership. So I don't think that the calculus is worth it for Beijing. I think the risk is that this could change over time. Beijing could decide that it's less risky and more urgent for them as time goes on. But I don't think that that calculus is going to shift such as to argue for an armed conflict over Taiwan anytime soon. We should add, though, we have a very important election coming up in Taiwan, January 13th, a presidential election, which is going to have an important bearing on these issues.
This is right where I wanted to go. Mike Herson, one final question. We've got to march on here with our day, and thank you so much for joining. But abruptly here, our stereotype is the KMT and the Pan-Blue Coalition. They lost in 2016. The domestic politics of Taiwan, are they uniformly for America and for independence, or is there a nuance there that Beijing can play off of?
There's a nuance. I do think fundamentally voters in Taiwan want to maintain the status quo. And the difference between the two camps really is what is the best way to maintain that status quo? Keeping China at an arm's length or engaging with China in a more close, political, economic relationship?
A terrific brief. Michael Herson, thank you so much. Thrilled that he could join us this morning. We move on to more prosaic American domestic politics. Tom Porcelli joins us, chief U.S. economist at PGIM Fixed Income here, as we try to get our bearings in a melt up. I have to go to your wheelhouse. The Porcelli claim here, folks, is simple. Wage dynamics, wage analysis, ECI, EIEIO. And the answer here is you on the high ground. When does wage inflation break?
Yeah, look, I think it's starting. What's interesting is I think companies have a choice, right? If you're potentially on the verge of margin compression, we've talked about this, right? I think there's three things you could do, right? This is the basic playbook. Cut back hours, companies are doing that. You could cut back wages, and they're in the midst of doing that. And if those don't work, then you go after headcount. And so I think there's more work to do on the wage front, and we're seeing that, and I think that will persist. But you can have a situation where wage pressures, or wage growth, I should say, is running at a faster pace than his revenue growth. I mean, that's not sustainable. So something is going to continue to give there, and I think it's going to be wages.
You must be one of the very happy people seeing some of the rhetoric change from the Federal Reserve, since you've been talking about this for a while, that they should be cutting rates and that you do see weakness coming down the pike, and that disinflation has been very much in the fore. To Jim Caron's point, have we brought forward all of the potential good news, the pivots, the shifts that we could have potentially gotten next year?
Yeah, so I actually, I worked with Jim for a long time, and when I heard he was going to be on, I thought he was going to be here, so I was totally disappointed that he wasn't here.
Sorry, we couldn't do that for you.
Jim, shame on you. Exactly. So I think that the one thing that we've continued to say is, and thank you for the plug, by the way, because we've had a pretty good call. Look, I would say this: you get through, this uncertain period. Is the Fed going to cut? What's going to happen from a growth perspective? And let's say we're right. Our view that the Fed does cut a few times next year, that growth does slow down to 1%, which will feel pretty recessionary for some people, which is an unfortunate reality because the unemployment rate is going to rise. But here's the thing: what happens on the other side of that, right? Like, how do you get through that? What's the catalyst to get to a higher plane from a growth perspective? And truthfully, we just don't see that. Not in the immediate term. I think over the more medium to long term, I think the productivity story, I think that's a really sort of interesting story that can come out, that'll come to pass. But I think when I think about the next year or two, I don't really see any meaningful catalyst to sort of break us out of what could be a really sluggish growth backdrop.
So not stagflation, but just kind of sluggishness that is going to hurt maybe more than people realize. Is that your sense?
I think that's a fair way of characterizing what could be the next couple of years. Again, we put a lot of hope in this idea that there is this productivity dimension out there that I think is going to kick in. I guess the sort of the debate that we have is how quickly will it kick in. Once it does, great. But I think it'll take a little time, and I don't know what gets us from that. I don't know what the bridge is from here to there.
That's right where I wanted to go. With the new productivity, let's set it up as capital labor and something else we don't understand, like Red Sox baseball. The answer is you've got labor deepening. We've got haves and have-nots. We were just talking about record homelessness around a boom American economy, 5%, 2.7, whatever Atlanta GDP now says. And the answer is there's a wacko labor deepening going on in productivity. What is it?
Yeah, so listen, I think that this is a really important idea. Because I think when I think about the unemployment rate rising, right, which is what we expected, the Fed expects it, I mean, I think a lot of people expect it to happen in the coming year. So let's say the unemployment rate rises, and it's worth a million jobs. Where does that get hit? When we sort of go through all of the employment sectors, there's really only a few sectors that we see that have real imbalance. One of them is retail. I mean, you could see some real damage in the retail space. I mean, you're talking at least a few 100,000 jobs. As a corollary to that, you can then see transportation and warehousing get hit on the back of this. Again, they're very related. I mean, those two sectors alone, you could see up to 500,000 jobs and throw in tech. So I think that to me is the problem, right? That to me is the challenge. I mean, you're going to see unfortunately, this unemployment rate rise. If there's any good thing about this, is if you think about the retail space, you could see some transition, right? You could see some transition from retail workers going into, say, something like leisure and hospitality, right? I mean, from a skills perspective, they're roughly equivalent. So it can minimize some of the damage, but I think it's an inescapable reality that the unemployment rate is going to rise in the coming year.
I look at this, Tom, and the question is folding in the shock of the yield melt up, lower yield, higher bond price, and also the equity shock as well. It just sustains along the cash moving in from money market funds. Yeah. Now you're with PGIM. You're surrounded by smart guys in bonds. Yes. What's their belief on money market fund over to the Porcelli world?
Well, so the way that I'll answer that question is I'll say, one thing that I've found really interesting is the whole higher for longer narrative that the Fed put out there. And the one thing that I've said, I mean, and I think this is especially true when you think we were as high as 5% on 10s and now we're back down to 4%. I think there's been an element of price discovery that's been going on from the market, and not just from the market, but from the Fed too. I mean, I think we sort of all wondered, what does higher for longer actually mean? And so we've been in the price discovery mode. And I would say that higher for longer is something that we actually believe in. It's just I don't think we believe in it at 5%. I think 4% seems much more palatable to us.
All I could say is when we talk about sort of this complicated stew that's going to be over the next few years of slow growth, how much are some of the divergences that Tom's been talking about, the fact that there are 2 or 3 or 5 Americas really play into this? Yeah. I really was struck by this study showing that Americans over 70 hold more than 30% of the country's wealth. Yeah. We're seeing younger people not being able to buy homes in the same kind of way, and their politics are very different. Yeah. It's the fissures between the generations are really getting wider.
Yeah, I mean, here's and again, here's an interesting thing to think about, and I'm not making a call on this, but I'm just simply saying this is an interesting framing of your observation there. You keep on hearing about excess savings still, which just seems crazy all this time in. But when you think about whatever excess saving remains, because let's be clear, it's not in the sort of the middle and lower income cohorts. That's long since gone, right? But what excess saving does remain mostly sits in the upper income. And specifically sits in the sort of the top quintile. What's interesting about that is they don't need that money to spend. They'll never use that money to spend. That's not for spending. That's for investing. And I can easily see a scenario where they're trying to deploy that money. The Fed is going to cut rates a few times in the coming year, which is what we expect. Then all of a sudden, that money could easily find a home. I mean, it's sort of an interesting thing to think about.
Are we going to get an S&P PGIM call here? We couldn't get out of Greg Peters. Are you going to give us a PGIM equity call here?
I'm going to follow the big boss and bail on that one too.
Okay. Tom Porcelli was with PGIM here, looking at some of these odd dynamics and the levels here. These are futures levels. 4813 SPX, near 38,000 Dow, near 17,000 NASDAQ 100. Wow. Down 0.2% this morning.
That idea is such an interesting one that Tom Porcelli was just saying, which is that essentially the savings are for investment. That is the cash on the sidelines in upper quintile earners that have the money, that aren't going to go out and buy new watches. They're going to go out and they're going to buy stocks. So this is the question, right? Well, has that money already been unleashed to some degree? We've seen some of those cash piles really come in. Or is there that much more to go in terms of the balance of money market versus other investments?
This goes back to the 60s frenzy, which I just barely remember. And, certain other booms, 1999 into 2000. Oops, there were no profits. That ended harsh. But the answer here is stock ownership in America. And Eric Balchunas and the others here at Bloomberg that own the ETF High Ground the money's flowing in. The money's flowing in on individual stocks and the meme stuff. And I'm thinking of opening up an account at Robinhood just to keep my cool points going. But, you know, everybody's loving stocks right now. That's what the chart says.
On a broader economic picture, though, does it make the economy more fragile to have a group of people who are completely left out, who cannot spend,
there we go,
and who are dealing with slow growth while other people are looking for, you know, which stocks to buy? I mean, really, this is a question of longer-term fragility in an economy that might be a short-term boom for people who can invest.
That's a political debate, and I would suggest some of it is the new immediacy of social, the new immediacy of media. We didn't have that generations ago where there was a real separation. Now there's less so. These are the debates into 2024. The major debate we have is the late Ken Pruitt would say, Lisa needs 4 bedrooms and a WBF. A WBF is a wood-burning fireplace. Next, Jonathan Miller on Bramo's next pad. Stay with us. From New York, start shopping. This is Bloomberg Surveillance.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. The island emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
We had some pretty tough talk.
bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report, tonight at 9:30 Eastern. Bloomberg, context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Real World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Consumer capacity to borrow is strong. Mortgages are all locked in at low rates. That the best asset for a lot of households is actually their low interest cost liability. It's mixing two different things on the balance sheet, but the reality is a 3% mortgage is an asset for people right now because it means their payments haven't moved. So that's good news.
Brian Moynihan, Bank of America CEO, speaking yesterday with David Weston of Bloomberg about why there has been this optimism around housing, even though mortgage rates, yes, they've fallen to the lowest level since earlier this year, but still hovering around 7%, Tom. I mean, not exactly a great recipe for people wanting to get in.
What's great about Mr. Moynihan is he loves talking banking nerd talk. If you say, how about that Fed? He goes, I don't want to talk about that. He wants to talk about, mortgages. And, I love him for that. He loves to talk about the nitty. He's not like Diamond, who's running for Secretary of Treasury. Moynihan's like worried about, the Christmas Club account.
We'll get into housing and the real economy in just a second. I do want to just bring you a number of companies that are getting our attention this morning. FedEx, we were talking about how they were disappointing in their earnings last night. Those shares lower by more than 11%. Just a reminder, those shares had been up more than 60% year to date, but it shows how big of a penalty there can be to a miss. And it raises this question: if consumers aren't shipping as much, is this a broader macro concern for the consumer? UPS falling in tandem, and General Mills with a similar kind of sentiment, down 3.9% after volume and sales coming in lighter than expected, saying that there is a more cautious recovery, more cautious consumer. The cereal buying cohort not having a good time, or else people are just not buying cereal.
You look at the advent. Amoxicillin was a major invention. Right behind it, Honey Nut Cheerios.
I was going to say Lucky Charms, but carry on.
Well, Lucky Charms is good too, but Honey Nut Cheerios saved General Mills.
Well, we can all have our favorite cereal, although evidently it's on the outs these days because people don't like sugar, carbs, and other things. Just say that's one of the reasons why people have been cutting back on cereal. Let's get to the housing conversation because it has been so important. Yesterday, the data came out. Better than expected home building starts, better than expecting home builder sentiment the day before. How much are we seeing a sort of recovery in the housing market, despite the fact that, yes, mortgage rates have fallen, but not all that much? Jonathan Miller, president and CEO of Miller Samuel, who peruses all things real estate, joins us here on set. Are we seeing some sort of resurgence in the housing market, a feeling of activity, simply because mortgage rates are no longer 8%.
Yeah, I think it's an anticipation that 2024 will be there'll be more transaction volume than there was in 23. That 23 was sort of the bottom of the air quotes housing recession, where housing has been much weaker than the rest of the economy because of the spike in rates. And now we're going into 2024, and maybe it'll be the opposite scenario. The thing that I worry about in terms of a housing recovery is if we go into a hard recession where there's real job loss, because that doesn't help housing that much, no matter how low rates get.
Well, what's worse? The idea of a recession for the housing market long term, I mean, a recession that causes housing prices to essentially drop, or longer term, for the barrier to entry for buying a home to be so high that it prohibits an entire generation of getting in.
Right. So there's no great answer to that because all three scenarios have significant problems. The issue that I think we aren't going to see in 2024 that's going to would make housing cheaper for the generational cohort that's cut out is that we have to see a significant drop in rates. You were talking earlier that the spread between someone with a 3% 30-year fix and a 7%, I think we have to look at that as some sort of incremental change, that the more people, more rates tick lower, the more inventory will come into the market. But it won't be enough because rates are falling, so there'll be an increase in demand. So in many ways, I think we're sort of stuck, even in this improved condition for 2024 that's perceived, in sort of solving the problem.
I want to rip up the script here. Usually we talk cute stuff about Miami and Florida and why I didn't buy Coral Gables when you told me to. Jonathan Miller in Denver, rent is $2,100 average. In Manhattan, it's $4,400. This is not funny, folks. Everything is priced out in Manhattan. It's really, really not funny. You, with public service, have taken on a committee effort with the mayor of New York City. Who do we blame? And what can someone like Mayor Adams do about the housing crisis?
So the mantra really is build more housing. The problem is in New York, it is extremely lengthy. It's no surprise why developers tend to be families that have sort of passed through their expertise over generations. It's very old line because it's very complicated and very difficult. Land is at a massive premium in Manhattan, less so in the outer boroughs. And so to build the volume of new product coming in, even though we want to build more housing as a market, we have a lot of NIMBY, sort of not in my backyard type thing. We have zoning issues.
Is there a religion to change the litany you just described?
There doesn't seem to be, at least for the people in power that are able to make that change. And that's what's so frustrating. I mean, this has been a century-old problem with New York. 100 years ago, if you look at New York Times headlines, it was the same complaints. It was Wall Street is going to continue to be an important driver of real estate demand, and international buyers are driving prices higher, right? Nothing has really changed.
Is that so? We still see the international buyers, even amid some of the pullback, particularly from China?
Not so much right now. I mean, clearly the dollar is stronger, and so we're not seeing the sort of, intensity of demand on the market that really, especially more on the condo side, really drove it up. I mean, it's always a constant in the market, and we go through periods where it is stronger or weaker than the norm.
This is crucial from every point of view. The housing market, in one manner or another, is the linchpin behind a lot of the economic trajectories that we've seen over recent decades. From your perspective, do you think that the disinflation that we've seen, the decline that we've seen on the margins in rents, or at least the stability, can continue given the backdrop that you put out there, which is a tight housing market and a lot of people looking for an entry point after being locked out for a year?
I absolutely do. I see, rents peaked in the summer. We seem to be 4 to 6 months behind the national housing narrative of weakening rents. And I can't see rents tightening or rising quite a bit over the next year, because the reason why we've had this astronomical surge has been because of the spike in mortgage rates. And if that eases, because people were priced out, pushed into the rental market, which was already relatively tight, and then it became astronomical.
HB12C, folks, here's where we're going. Miller doesn't know how to use one of these, so we're going to do it for him. $3,900 a month. I'm over on 2nd Avenue, or wherever, the 2nd Avenue of Boston, the 2nd Avenue of Nashville. $46,800 annual rent. How much of my rent should I pay? How much of my income should I pay for rent? What percent?
In theory, 30% as a cap.
In theory, Jonathan Miller. So I got to make $156,000 large to get an entry rent in many urban cities. This is nuts.
Right.
Who's going to fix this?
The only way I can see to fix it is to build a lot more product than we're building now, supply and demand.
So we're going to make the place look like East Germany? I mean, that's a stereotype people are saying. Endless, dark, dusty skyscrapers out there. Is that what New York looks like in 30 years?
I don't think so, because I don't anticipate the city. Listen, the city has been trying to create a significant number of more affordable properties in the rental market for the last 15 years, and have very limited success. I don't see that really changing, and unfortunately, the problem with that is that the city, like many municipalities, not just New York, are pricing out their workers, right? And that's not good for the longevity of the city.
It's like Colorado. I mean, you look at a place like Steamboat Springs. I mean, people are driving from Utah to get this. They don't live in Grand Junction anymore. They're over in Utah in some shack in the woods, coming over to western Colorado. That's what they're...
Right, they're taking on longer commutes to find greater affordability.
What's the average commute in New York? Only you would know this.
Well, it's just under an hour.
Yeah,
and
that's down Fifth Avenue.
But I think that's...
I love busting your chops. You're our single worst guest. You make me miserable when you come on.
I love having you on. Thank you, Jonathan Miller.
Thank you so much. Truly, folks, the expert on our housing economy in America. Lisa Bramowitz and Tom Keene. Jonathan, is John gone? Is he at Bloomingdale's? Santa Land, 10 a.m. It opens.
You didn't get the job, but
Good morning.
He's looking for it.
If you're losing more than half the electricity you put into electrolysis, is it a viable alternative to some of those fossil fuels?
Yeah. I mean, have you heard of oil? Have you heard of gas? I mean, you convert oil out of the ground, refine it, turn it to diesel, whatever you like, which is going to cook the planet. You've already lost 60 to 70%. I mean, yes, there is a conversion loss from not losing an electron going from wind and solar straight into the grid. That's why it's the lowest cost energy in the world. But there's a conversion loss. Oh my God, a conversion loss. The oil and gas sector, green hydrogen's got a conversion loss. It's like putting lipstick on a pig from the oil and gas sector. They have had a conversion loss since 1810, right? And remember, relative dollars, their dollar per barrel was $1,600. Let's not forget that. That's how they got going. Subsidies, $1,600. Wow, it's better than burning wood. Now those same companies stand in the road of green hydrogen and say, oh my God, it's not as efficient as us. We've only had a 200-year head start. Hundreds of trillions of subsidies, which we've swallowed from taxpayers. They should get none, and they want to do it in 8 or 9 years. You know, who would you back? I back us.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, you know, in 5 years from now, we will not have sacrificed, you know, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
3 consecutive days of all-time highs on the NASDAQ 100, the S&P 500, not too far behind. Live from New York City this morning. Good morning, good morning. Equities just a little bit softer here on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, global disinflation silencing central bankers, FedEx tumbling after profit misses estimates, and Wall Street bosses planning tepid bonuses. We begin with the big issue, too much of a good thing.
It has been an absolutely enormous rally here.
Massive rally in equity.
Rally across risk assets, rally everywhere and anywhere, it seems.
I think equities have a ways to go.
We have some room for risk to continue to rally. There's so much optimism in the markets right now.
I tend to be a little bit more cautious.
Tactically a bit cautious.
We want to temper expectations a little bit around the equity market.
The market's already well ahead of the Fed.
It feels a little bit like an impatient child at Christmas.
They're so far ahead of what the economic fundamentals would suggest.
It just looks like we've gotten a little bit too exaggerated.
If anything, this is a great point to start taking profits and look for alternative positioning for next year.
If we don't just trim a little bit in here, we may see trim early in the first quarter of next year.
I would argue ready for a cautious start to the year.
Let's have that conversation right now. Joining us is Wells Fargo's Darryl Cronk, Cameron Dawson of New Edge Wealth. Cameron, I want to come straight to you and reflect on the fund manager survey that came out of Bank of America in the last 24 hours. Most upbeat survey they've had since January of 2022. Cash levels at 2-year lows. Big question for us this morning here at Bloomberg. Cameron, just how one-sided has this market become in the last 2 months?
Well, it certainly looks like it has become very one-sided, and it is a scary world when everybody gets on one side of the boat. Now, if we look at outside of the fund manager survey, which of course, as you mentioned, shows that positioning is at the most bullish since early 2022, we know what happened after that, but we do still see a little bit of room for retail to get pulled into this market. You can look at AAII equity allocations, still about 4% off of their prior highs, and if you look at things like FINRA margin loans, there's still room for people to take a bit more risk. So the market is very extended. We do see it being very overbought, but we're in this melt-up period. And so oftentimes things can get even sillier before they really do have a pullback.
Darryl Cronk, do you agree?
So, John, happy holidays, first of all. Good morning. So I do think you have to be careful here on the technicals with where they are. You don't want to stand in front of a tape and a steamroller when things are this strong, especially heading into year end. We've only got 7-8 sessions left in the trading thing. What we're looking at, though, you know, Candor, is positioning, sentiment, seasonals, and valuation, right? Positioning, CTFC futures are basically back at their peak. Cameron mentioned AAII sentiment surveys are a full 1 standard deviation above their long-term average. Valuations against the U.S. against international markets are back on top of their cycle peaks. And seasonals, we're losing some of the seasonal firepower. The last 4 Januaries, 3 of the 4 Januaries have been negative. So, you know, you've got a lot of things beyond the technicals that are probably starting to flash a little bit of yellow and red after this 7-week kind of rip-your-face-off rally.
Part of the move just feels like chasing some underperformance through the year. For people who missed it, Cameron, chasing in the places where we didn't get performance. I'm thinking small caps, I'm thinking about the banks outside of, say, big tech. When you look at the S&P 500 493, for the S&P 493, stripping out the Magnificent Seven, Cameron, do you see reasons for sustainable outperformance?
I think we have to make a clear distinction between those with good balance sheets and those with bad balance sheets. We've seen everything rally over the last couple of months, including those names with bad balance sheets, with the idea that lower interest rates and easier Fed kind of takes the pressure off of these names. But that is at risk of reversal if you see interest rates move in the opposite direction, or if the Fed doesn't deliver on those 6.5 cuts that the bond market has priced in. So I think that there is value outside of the mega caps in the rest of the 493, but we still think that we want to focus on names with those good balance sheets. And so that's where we would fish in looking for value opportunities.
Darryl, we've had days where the small caps have ripped. You're not buying it. Large over small, DM over EM. Why is that the position for you?
Yeah, I mean, obviously, as we sit here this morning, small caps are still underperforming large caps year to date by 1,000 basis points. Now, admittedly, they've narrowed that margin from 1,700 basis points where they were 6-7 weeks ago. So they've seen some short-term move. But let's be honest, John, I mean, small caps are still challenged on an earnings standpoint. You still have the zombie companies that can't cover their interest expense. About 40% of the Russell 2 is sitting on floating rate debt, which has to get reset here as we move into 2024. So I remember, you know, been doing this long enough that every year we walk into the year and everybody says, small caps, this is the moment that they finally shine. This is the moment that they take the leadership realm. And it's disappointed every single year. So I need to see more in fundamentals before I can believe small caps can lead, other than just a big beta rally and everybody jumps on smalls as a big beta play.
25 minutes away from the opening bell. Equity futures right now on the S&P are negative by 0.2%. We need to talk about Chairman Powell as well, and a chorus of Fed speakers over the last week or so. Ira Jersey joins us now with more. Ira, I've said a few times that any kind of pushback from any central bank is only as credible as the data behind the pushback. And all I'm seeing at the moment is disinflation in the UK and disinflation stateside as well.
Yeah, I think that the market's not taking the post-Powell press conference speakers very seriously. I mean, it's pretty clear with the price action that we've seen. The market's really focused on the comments like, you know, we will cut if inflation continues to come down. And like you said, John, a lot of the data that we see does suggest that inflation's continuing to fall. Now, I do think that the market's gotten a little bit ahead of itself, particularly in the magnitude of rate cuts for next year. But it does seem like it's more likely than not we're going to get some form of rate cut next year. It's just a matter of when do they start and how far down do rates go.
The gap is huge. Ira, thank you. Cameron, I want to come to you on that. The difference between where the Fed is at, implied by that median dot for 2024, and where the market is at. How are we going to reconcile those differences? How does that spread close?
Yeah, I think it comes back to the data, but the data has two sides to it. It's not just inflation data coming down, but what does the Fed make sense of growth data remaining very strong? When Powell gave his speech last week, what you had is the Atlanta Fed GDP now looked like growth was decelerating a lot and even back below trend. But then it quickly got revised higher as retail sales came in better than expected. Look at housing starts yesterday. And so we've seen this reacceleration in data. Is that a concern for the Fed? I think it comes down to the ultimate question, which is that how much of this inflation was structural versus cyclical? And if it was structural, then if we have higher growth, could that lead to higher prices, which of course is something that the Fed would not want to be cutting rates into. So that's the ultimate question for 2024.
Darryl, how would you answer that question?
Yeah, I think Cameron's right. There is a fair amount of it that is non-structural post-pandemic. I think what's important here, John, I mean, think back to where we were this time last year. As we started 2023, you know where the 10-year U.S. Treasury yield was if you pull up a chart? 3.88. You know where we are this morning? 3.88. Right? We have completely round-tripped rates after, you know, probably one of the biggest rate volatility move indexes since the 1980s. And yet high-yield spreads have come from 470 over down to 335 this morning. Right? So there's big moves in the bond market that I think have to get reconciled. If bond volatility was the story and rate volatility was the story of 2023, you know, now that we're sitting on equity low volatility for the cycle with a VIX of 12 and change, is equity volatility the story for 2024? We think it probably is in some ways.
Cameron, what's your take on that?
Yeah, I think that complacency is the biggest risk. And if we also add the dynamics of supply and demand in the bond market, one of the reasons why we have seen spreads come in so much for credit is because you've effectively had negative net new issuance as companies have retired debt. A lot of that now will turn positive, meaning we'll have positive net new issuance. What does that mean for spreads? And could we see some of that downward movement in spread compression actually reverse, even without going into a big negative credit event? So I think that, to Daryl's point, complacency probably is the biggest risk as we move into 2024.
That could be a big story for next year, with high yield spreads incredibly tight, near the tights of the year. Daryl Cron, Cameron Dawson, going to stick with us, about 21 minutes away from the cash open. Equity futures on the S&P 500 pulling back just a touch by 0.2% on the S&P. Let's get you some movers going into that open. Let's say good morning to Abby.
Good morning, John. And one stock that is really weighing on futures, FedEx. Shares are down severely. Last time I looked, down more than 10%. This after profits did disappoint. Adjusted earnings missing by 4.8%. Sales were light by 1%. All of this on light volumes. On top of it, the 2024 outlook is disappointing the street. Citi calling it vague. General Mills also down about 4%. They beat estimates, but they cut their outlook as consumers are turning cautious. The company is seeing strong, what they are calling value-seeking behavior. And then finally, Alphabet, a bit of a bright spot here, up 1.4%, heading toward its fourth up day in a row, the longest potential winning streak in more than a month, after they reached a $700 million settlement with states over its Android app store. This involves 36 states, many consumers. It's separate from the Epic lawsuit loss in San Francisco, perhaps setting a precedent for that case, too, that there will be another sort of settlement ahead around that.
Abby, thanks for the update. More from Abigail around the opening bell. Coming up on this program, FedEx tumbling as earnings disappoint.
FedEx and UPS raise rates somewhere between 5 and 7% every January. And at some point, you have to ask the question, do I really need to get my package there first thing in the morning? You see people trading down from express to ground. And that's the future.
That conversation up next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
FedEx and UPS raise rates somewhere between 5 and 7% every January. And at some point, you have to ask the question, do I really need to get my package there first thing in the morning? Can it get there in the afternoon? And to the extent the answer is yes, you see people trading down from express to ground. And that's the future.
FedEx stock flying high on the year, punished today following disappointing results. The company's air freight unit struggling from overcapacity as commercial airline activity picks up. The CEO attempting to temper concerns, saying this: "I'm very confident the margins at Express will return." Katie Grafford has the story. Morning, Katie.
Morning, John. Yeah, a rough morning for FedEx, to put it mildly. The progress that the company has made on cost cuts wasn't enough to make up for volume declines that you saw at that air freight business, FedEx Express. While the ground unit, actually, there was a bright spot to be found. Sales actually rose on higher volume and revenue per package. It was the air freight unit still struggling from overcapacity and also sluggish demand from Asia. Meanwhile, the FedEx Freight unit, which is one of the largest U.S. trucking companies, it's been hurt by a drop in cargo demand and price. You put that together, and adjusted earnings were $3.99. That is below the analyst expectation of $4.19. You also had a lowered sales forecast as well to a low single-digit percentage decline. Previously, that forecast was for little change. So that is dragging shares lower today, as you can see this morning. But the sell side saying this wasn't that bad, not as bad as maybe the share price is suggesting. You take a look at Citi writing that while the results were disappointing in the Express unit, they believe that the outlook for the company is not as bad as those results would suggest. And Jeffrey is saying that ground margin is good. Again, you find a bright spot there, and that expectations were extremely hot coming into this print. So a high bar, shares down 11% right now.
The bar was super high. Katie, thanks for the update. We're down 11% now. Before today, we were higher by almost 62% on that name. And there are plenty other names like that on the S&P 500. Daryl Cronk, Cameron Dawson back with us. Cameron, it makes you think, just looking at FedEx, how high is the bar going into earnings season, kicking off in January?
Yeah, obviously, given this move and chase higher, I think it probably is higher today than it was back at the end of October. But FedEx is the poster child of normalization post-pandemic. You had so much capacity added to the transportation market in response to work from home and everything buying online. So I'm not sure how much we can read into a broader macro story from FedEx. Always it is concerning when such a cyclical company is flashing warning signs. It usually is correlated to global trade, which many do expect to rebound next year. So this could raise some questions about that, but this is one of many profit improvement plans that FedEx has had over the years, and clearly there are challenges.
Yeah, Daryl, let's add to that. Do you think there is a signal here for broader expectations going through earnings season?
I actually do think there's a signal, and I think Cameron somewhat nailed it. 2 points that I think are really important to take out of this morning's news, or yesterday afternoon's news, and this morning's price reaction. One is the global trade story. I mean, FedEx is a global company, and if you just look at the globe in 2023 as we close it down, Europe's unquestionably in a recession. China has underwhelmed, expectations for growth and reopening and all that stuff from 23. And the U.S. has surprised to the upside. So the U.S. is the island unto itself. But if that global scenario and global trade doesn't pick up, you're going to see companies like FedEx continue to struggle. The second point, which I think is maybe even more important narrative, John, here, is the pricing power at the top line, right? So yes, maybe people are trading down from express to ground, but the reality is, can companies push through that price increase that they've done the last couple of years into 2024? We're a little skeptical, color me skeptical on that. I think we're starting to lose that engine on pricing power on the top line, which means that to protect the bottom line earnings, you got to defend the margin line, and that means defending the cost structures.
So that's cost cuts, and ultimately, does that mean higher unemployment, Daryl, going through next year?
Yes, absolutely. I mean, 3.7% unemployment. It is one of the surprises of 2023 that the tight labor markets have just persisted as long as they have. Now, we've turned immigration back on, But I'd be shocked if this time next year, John, that we're still sitting at 3.7% unemployment. The question becomes, I think north of 4.5%, maybe 5% is when the Fed starts to blink on its dual mandate here a little bit and perhaps get more aggressive or need to get more aggressive on cutting rates, which is likely what the bond market is pricing in right now.
Are they already blinking? I think that's the question, Cameron. We heard from the San Francisco Fed President, Mary Daly, shifting the attention from inflation, price stability, towards the prospect of unemployment and higher unemployment. Do you sense that shift as well across the whole committee, or just for individuals like Mary Daly?
Yeah, certainly we've heard from some members seeming to endorse that we don't have to get back to 2% inflation before they would cut rates. The question is that because they're sensing some underlying concern to growth? We don't really see that in the hard data yet. Yes, soft data is signaling that things are slowing down, but that's been the case for all of 2023. It's not showing up in hard data yet. So that just means that maybe there are other things that they're considering. Maybe there is, and it's somewhat of a conspiracy theory at this point, but a relationship with Treasury funding needs and all of the bill issuance that's happened in response to the large deficit. How much did that, and maybe not spoken out loud, play into the fact that they did this pivot despite the fact that hard data is holding up?
Given that you've just said it, I've got to ask you, do you think there's something to it?
I think that there is something to it, simply because we saw interest rate expense move so much higher so quickly to the point that it would constrain the Treasury's ability to continue to do spending as it was crowding out other areas. It's getting to the point that was getting even larger than the defense budget. So clearly that is something, it may not be part of the dual mandate, but clearly it's a consideration that likely led to this pivot, again, because the hard data doesn't necessarily support the narrative that the economy is rapidly weakening.
So, Darryl, when we talk about the Fed put supporting Wall Street, are we really talking about the Fed put supporting Congress, supporting the White House?
Well, that's probably a confrontational thing, right? Especially heading into an election year. But here's what I would say, John, right? The reality is, I think, and I would put us in this camp, what we probably expected or didn't factor in as much as we should have in 2023 is the immense amount of liquidity, primarily fiscal liquidity, right? When you think about what's happened with the budget deficit going from $1 trillion to $2 trillion, I don't think many were expecting that, certainly the CBO wasn't. And then you also show this idea that the reverse repo market and the work that Treasury is doing around bringing that down from over $2 trillion to sub $1 trillion has infused a huge amount of liquidity into the markets. That's supported risk assets through all of 2023. The question is, do they still have those levers into 2024 to pull to maintain that elevated level of liquidity that supports risk assets? I think that's the right question to ask as we get ready to turn the calendar here in 2024. And oh, by the way, John, happy holidays to you, my friend.
Happy Christmas to you as well, sir. Can I just say that was a fantastic diplomatic dodge of that question I asked about 2 minutes ago, Darryl, but I won't ask it again. I want to talk about lessons from 2023 before you both go. A year ago, 12 months ago, looking out 1 year, looking out 12 months, the average forecast on Wall Street for the S&P 500, the average price target was 4,000 points. Based on where we are right now, we could finish 20% above that. Cameron, not everyone got it wrong, but most people did. When you reflect on lessons of 2023, does it help you as we look out to 2024?
Expect the unexpected, I think, is the key lesson from 2023. But I think Darryl's point about liquidity probably is the most important lesson. We weren't counting on liquidity becoming more abundant this year, mostly as the Fed was raising rates and continuing to do QT, but it did. And that was the key source of multiple expansion. The upside to the markets did not come from the earnings line. It came because the market re-rated 20% for the S&P, 35% for the NASDAQ. Yes, we rolled forward and earnings are a boost into 2024, but that liquidity tailwind was the key driver of this upside. So the ultimate question is, where does that go in 24?
Darryl Cronk, final word, please.
Well, I think 2023, when it goes in the history books, will be a year of, falling inflation, which everybody expected, a stronger, more resilient consumer than I think most expected, including ourselves, tighter labor markets than most expected and that abundance of liquidity. So I think what we've priced in now, John, in a lot of ways, is we've got all the macro tailwinds behind us, right? We've got the Fed rate cuts in, we've got the soft landing in, we've got the falling inflation or inflation having fallen. Now we need the micro to deliver into 24. We need companies to deliver in earnings growth again and not just multiple expansion. So I think that is what we have to watch as we turn the calendar.
Darryl Cronk, thank you, sir. Cameron Dawson, to both of you, thank you for everything through 2023 as well. Always appreciate it. Thank you to you both. About 7 minutes away from that opening bell. Equity futures pulling back by 0.2% on the S&P. The earnings calendar, which is what Darryl Cronk's talking about. Middle of January, JP Morgan. You want some tech names? Early February, we should hear from Apple. Coming up on this program, the morning calls, and later, George Bory of Allspring, and why the Fed has set the stage for a bond market rally next year. That's coming up from New York. This is Bloomberg.
What did you learn in the last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
5 minutes away from the opening bounce. Stocks pulling back just a touch, just a little bit. That's the price action. Let's get you some morning calls. Your first one from Wells Fargo, downgrading Zoom Video to underweight with a $70 price target, citing a lack of clear growth and margin strategy going forward. Citi upgrading Discover to buy from neutral, price target 133, seeing several potential catalysts for shares over the next year. And finally, Susquehanna raising its price target on Carnival to 22 from 16, seeing checks and data pointing to strong demand in 2024. The stock is down about 0.75%. Coming up, Allspring's George Bory on why the Goldilocks moment is upon us. Your opening bell just around the corner.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The island emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
We had some pretty tough talk.
bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report, tonight at 9:30 Eastern. Bloomberg, context changes everything.
Five seconds away from the opening bow this morning. Good morning. Equities pulling back just a touch on the S&P 500. On Friday, the Nasdaq 100 record. Monday, record. Tuesday, record. The S&P 500 not too far behind that all-time high from early 2022. Live from New York City this morning, the opening bell in New York just about ringing, a little bit late. Let's switch at the board and get to the bond market. Yields look like this on a 10-year. Yields on a 10-year this morning, higher then lower by 4 basis points. On a 10-year, 389.20. On a 10-year, following CPI data out of the UK, a downside surprise on CPI in the United Kingdom. That rally in the gilt market spilling over to the Treasury market, and that's been the story of the last few months, hasn't it? Any pushback from central bankers, we've said this a few times, only as credible as the data behind it. So if you're on the Bank of England right now, pushing for rate hikes, that CPI is going to totally silence the message coming from you. That's the story over in the United Kingdom. In the foreign exchange market, the dollar just a little stronger against the euro, 109.63. That currency pair pulling back by 0.16% on the euro against the dollar. And crude elevated. We'll talk about what's happening in the Suez Canal a little bit later in the program. We're up by 1.7% on WTI, $75.20. About 1 minute into this session, pulling back by 0.2% on the S&P, down about 0.1% on the Nasdaq. One sector to watch at the open is the banks. Bonuses for traders might be a little bit slimmer in the new year. Abby has more. Hey, Abby.
Hey, John, and this is not necessarily intuitive, at least not to me, because when we think about the stock market this year, we have the S&P 500 up more than 20%. We have the NASDAQ 100, I believe, up more than 50%. You would think this would be good for Wall Street traders, not to mention the volatility, but that is simply not the case right now. Instead, it seems banks are looking at the drought in deal-making, M&A at another low level this year following last year. In addition, earlier this year, we did, of course, have some of those regional banks collapse. I actually, the other day in the rainstorm, saw somebody walking under a First Republic Bank umbrella. I was thinking, well, that's a bit of a relic. Now, of course, JP Morgan sucked them in. JP Morgan is one of these big banks that is basically, it's expected that their bonus pool will stay flat to next year. Citi, the biggest restructuring in more than a decade, their bonus pool could actually decline a little bit if it doesn't stay flat. Goldman and Bank of America, on the other hand, there is a chance that some of their traders may see their bonuses rise by a couple of percentage points. Goldman, of of course, last year, cut bonuses, so they have a lot of room. As for these stocks, though, John, as you know, it's been a rip-roaring rally over the last couple of weeks. The KRE, that regional bank ETF, up 40% since late October. JP Morgan up 24%, lagging the KBW, that bank index, by 10%, up 35%. What a rally.
What a move. What a move in just a few months. Abby, thanks for that. Let's turn to earnings. Micron is set to report its results after the closing bell. Let's catch up with Alex Webb out of London. Morning, Alex. Run us through what to expect.
Yeah, the market's really looking for more sign of the recovery. Don't forget that almost exactly a year ago, Micron was cutting jobs by 10% in the fiscal year that ended at the end of August. They experienced a 50% decline in revenue. That was largely due to overcapacity in the memory chip industry as a whole. Micron was the first mover to really cut that capacity, but crucially, big competitors, SK Hynix and Samsung, did the same. That has slightly rebalanced the supply-demand equation in favor of these companies. But we're still looking at a $1 billion operating loss in this quarter, a $1 loss per share. That's what the market is expecting in the quarter that has just ended. In the current quarter, there is some optimism about hope for a little bit of an upgrade, a little bit of more optimistic guidance. But ultimately, it's really focusing on whether that trajectory of the market as a whole is going in the right direction and things might start picking up properly at the end of 2024.
The numbers coming a little later. Alex, thanks for that. The stock is down by 1.3%. Let's stick with tech. So we've got watch bans and issues in China, and none of that is enough to stop Dan Ives of Wedbush putting out a major call for Apple. We believe Apple will be the first $4 trillion market cap by the end of 2024, given the pace of growth and monetization we estimate for Cupertino over the next year. They maintain their outperform rating and $250 price target. At the moment, their stock is unchanged at $196.88. Caught it with Dan a little bit earlier this morning. Guess what? Dan's still bullish. Sticking with earnings, FedEx with a big profit miss and a big move lower. Katie Greifeld back with us. Hey, Katie.
Hey, John. And that miss was driven solely by the Express unit. That's the view of a Citi analyst in a note out this morning. Express, it's their air freight unit. It's FedEx's largest unit by sales, making matters worse. And it's really been struggling from overcapacity as commercial airlines resume, and also as demand from Asia remains sluggish. So meanwhile, you look at ground and you look at freight, they actually both beat on profit, but that wasn't enough to outweigh the issues that we saw at the Express unit. So overall, adjusted earnings came in at $3.99. That is below the analyst expectation going in of $4.19. You also had sales overall come in light as well. And FedEx also lowered its sales forecast to a low single-digit percentage decline from an earlier forecast of little change. And as we discussed a few minutes ago, the bar was really high for FedEx coming into this print. You think about that 61% year-to-date rally heading into yesterday's close. Right now, you're looking at its worst one-day drop since September 2022, John.
Katie, thank you. How many moves are we going to see like this one in early January, mid-January, when we start to get earnings from, say, the banks, and then you start to hear from tech as well, as the bar being set pretty high going into earnings season? Katie, thanks again. Let's get more on some earnings for you. Sales of General Mills falling short of estimates this morning. Simone Foxman has the story. Hey, Simone.
Hey, John. Yeah, shares now down about 2.5%. They had been down quite a bit more in pre-market. This is the biggest drop since June for this company. And it's all about the company's volume problems. Organic net sales unexpectedly dropping about 2%. The expectation is that they would be higher by close to 3%. Particular weakness among the pet food sector. And when you look at the overall volumes, the amount that General Mills sold, it was down 4% since last year. This all resulting in a lower outlook for the fiscal year 2024 that ends in May. Seeing organic net sales now negative 1% to flat. They had been looking for 3 to 4% growth, and the estimate, the street's estimate, had been close to that 3% number. Now, this is, part of the story for a lot of these consumer names. They've been passing on price increases to their customers for the last couple of years, and when you look at the price increases they've been passing on, it's been double digits through most of this past calendar year. Not so anymore for this quarter, this past quarter, 3% year-on-year price increases, and this really dovetails with what we're seeing. CPI CPI for food at home coming in at 1.7% year on year back in November. Food away from home still a little bit more. Barclays saying this is, again, the same story as it appears, but the magnitude of this top line weakness is what traders are trading on this morning, talking more forcefully than about the consumer weakness than some of their peers. Bright spot, EPS, bottom line, came in a little ahead of estimates, as well as gross margins. But, broadly, I think we're seeing the weakness in this volume story because consumers just aren't buying General Mills products, John.
Simone, thank you. Stock is lower, down by 2%, trading at 65.32. The broader market, about 7 minutes into the session on the equity market, pulling back by 0.15% on the S&P. The Nasdaq virtually unchanged as well. Likewise on the Russell, the small caps pulling back just a touch after absolutely flying more recently. More outlooks for you. This from Allsprings, George Bory, looking into next year, writing this. As we head into 2024, the Goldilocks moment is upon us. The Fed pivot last week sets the stage for lower front-end yields next year. We expect lower yields, but this time could be different. George joins us right now for more. George, you're dead on, and I want to build on it as well. And great to catch up, buddy, as always. The soft landing is not a forecast about the future. It's where we are right now. Just the very fact that we've had this disinflation and unemployment is still south of 4% is phenomenal. 12 months ago, almost unthinkable for so many people on Wall Street. George, what are the odds that that continues?
Yeah, good morning, John, and thanks for having me on the show. Yeah, we are in the midst of a Goldilocks moment. And from a bond investor's perspective, the stars have really aligned over the last couple of weeks as both inflation has continued to notch a little bit lower, but at least pointing in the right direction from the Fed's perspective. Growth is showing some signs of moderation. And then most importantly, the Fed, as we mentioned in our note, the Fed has really signaled that they're willing to start to ease rates as we go into next year. And, when we look at sort of bond market fundamentals, they've been fairly favorable for the better part of this year as policy rates have been meaningfully above inflation rates. But it took a while for the market to really kind of take hold of that, to understand it, and really to start to price it. So as we go into next year, there's a good argument to be made that the trend's going to remain, that we will see a little bit more disinflation. We think some of that will be sticky, but inflation should come down. Growth is likely to moderate, which is really what the consensus view is. And then it really all comes down to the Fed. And the market is pricing a very aggressive easing in the Fed. We think that's a little overcooked. But when we look back through time, about 2/3 of a bond market move over a cycle happens in the period leading up to the first rate cut. And if we sort of cuff that at some time towards the middle of next year, that means rates can continue to come down a bit. We've seen a substantial rally, as we know, since the highs back on October 17th. But the fundamentals are in place. The Fed's giving us a good signal. And as we've seen over the last couple of weeks, that the technicals are very, very strong as investors try and lock in those yields to set up for next year.
I think we caught up in early November and you were adding to duration, certainly the right thing to do given where yields were through October. You offered us a range of 4.50 to 5% on a 10-year. We've broken well below that. George, I just wonder what your range is right now for the 10-year going into next year.
Yeah, I mean, we're thinking that we could get down to about 3.5%. A lot of that has to do with inflation. We think that remains the linchpin in this entire kind of discussion, if you will. It's what's really baked into the cake, this orderly and smooth disinflationary trend that's really priced into markets right now. There's a good chance we're going to head in that direction. We would certainly debate whether it's going to be as orderly as the market expects. And so there could be some stickiness to that number. The bottom, sort of the low end of the range, we would put at about 3.5%. But we really think sort of the 3.5 to 4 is kind of fair value for an economy that's still expanding, inflation that's still above the Fed's target, and what would likely be kind of unprecedented policy moves. If the Fed's moving in response to inflation, not growth, then they'd likely move slowly. They probably move with a lot of discipline, and they're unlikely to move with that kind of shock and awe type of strategy that they typically employ when the economy is collapsing. So, you know, we are in somewhat of uncharted territory as we go into next year. And that's why we really tell investors to do basically three things. One, diversify your duration. Be spread out across the curve. Try and benefit from a meaningful shift and possibly a twist. Number two, be as flexible as you can in your strategy. And number three, be very, very disciplined, very specific with your risk positioning, because we have these huge range of outcomes. Earlier in your show, you talked about the possibility of both a very hard landing or a very soft landing. We don't think that either of those happen, but they're distinctly possible.
You're absolutely right, George. I think it's absolutely right, correct, to make the distinction between easing and simply cutting interest rates. Not all rate cuts are created equally. If you're easing because growth has collapsed, that's a different story. If you're cutting rates because disinflation continues, but we remain above neutral, what are we talking about? George, so are we talking about, what, 75 basis points on slipping inflation? Or are we thinking about a full easing cycle off the back of collapsing growth? And if it's one or the other, where does that leave your call for credit with spreads right now near the tights of the year at 335 on high yield?
I mean, spreads are tight. We would certainly agree with that, but it means that spreads kind of get caught in a bit of a range, because that inflationary environment is still healthy from an economic perspective. So there's a lot of work to be done. You know, the one thing when we look across, particularly the corporate bond market, there's still significant dispersion. There's a lot of credit selection that can be done. And as we know, the cost of borrowing's moved up. So we expect to see a lot of credit volatility at the single name level. So picking those right credits becomes absolutely critical. And that's the difference between a 4% return and perhaps a 6 or 7% return in a typical bond portfolio. If we go into high yield, you know, we're going to be talking between 6 and 8%, and much of that's going to come down to which bonds do you actually own, which companies are you actually lending to, and there are a wide range of outcomes. Default rates are still going up, the cost of borrowing is still relatively high, and we are facing into somewhat of a debt refinancing wave that's kind of coming at us. So we like the corporate bond market. We know spreads are going to stay pretty tight, but that dispersion gives us a tremendous amount of opportunity to add value back into portfolios.
We've priced in a lot of the good stuff for 2024. I just wonder how resilient this market will prove to be. George, thank you, sir. George Bory of Allspring on the outlook for 2024. This is where we are about 14 minutes into the session on the S&P, pulling back just a little bit by 0.1%. Coming up on this program, the Red Sea reality check continues.
Less about oil prices, commodities prices, because supply feels comfortable to markets, but about the supply chain and, you know, two words, Suez crisis.
Team coverage up next.
In a couple of drugstores, even in my area, which is not the poorest area in Washington, D.C., it's a nice upscale sort of area. When I want to get razor blades, you have to go to the front of the place and ask somebody to unlock it. Why are you locking up razor blades and other things that I might want to buy?
Yes.
So, this is a national problem, and, this isn't, random theft. This is organized crime. And, state legislation has put guidelines on, how much the theft that you can steal before you're convicted. So it's a $1,000 limit. But we have been partnering with other retailers and sharing our camera feed. I know some of our partners here from Walmart are here, but we're all part of an organization that's coming together that says if you've, we can put our camera feed together and tell that that person has been in our store and their store, and the numbers are higher than 1,000. So we've been able to impact these theft rings most recently.
What are the things that are unlocking key the most? What are people trying to steal the most, other than razor blades?
I will tell you, it started at razor blades because that's such a high ticket item, but, it's a lot of cosmetics. But really what happens is that they take advantage of what I would call the elbow move, and they just come in and swipe a counter. And so it's just a matter of categories now.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
They're starting to get concerned because, we're talking about Houthi rebels firing tens of thousands of drones, and the U.S. and the Western powers that have kind of cobbled together a so-called armada are blasting them with surface-to-air missiles. This is less about oil prices, commodities prices, because supply feels comfortable to markets, but about the supply chain and, two words, Suez crisis.
Tina Fordham there at Fordham Global, weighing in on the geopolitical tightrope hanging over the Red Sea as Houthi attacks persist, the US and its allies wondering if a task force is enough, weighing an offensive hit on the rebel group at their nucleus in Yemen.
Bottom line is, these attacks have to stop. They need to stop. They're unacceptable. The United States, our allies and our partners will do what we have to do to counter these threats and to protect these ships.
This as stalled operations in the waterway continue to ripple out, ship insurance jumping, oil extending a rally. Let's get to the team coverage. Simon Casey in New York, Kelly Lyons in DC. Simon, first to you, just on insurance, how much more expensive is it getting for the ships that can go through the Suez Canal?
Well, the costs have almost, in fact, more than doubled since the beginning of this month. If you calculated on the value of the hull to get insurance to sail through the Red Sea now, it's 0.5% of the total value. It was between 0.1 and 0.2 just at the beginning of this month. There's a massive increase in the space of really a week or 2 weeks. And obviously that's putting off a lot of people from sailing through the Red Sea now. We're seeing tankers, oil tankers, LNG tankers, and of course, container ships as well. Over 100 container ships have changed route now and are sailing around Africa instead.
Kelly, is a task force enough? Are we finding out quickly that maybe it won't be?
Well, that's the question the Biden administration is grappling with, John. Obviously, this maritime task force was announced just earlier this week, intended to continue the work the U.S. military is already engaged in this region. Those military vessels shooting down incoming missiles and drones, really operating defensively, helping ships that need it. But the question of whether or not this needs to move into offensive territory is what they are now considering. According to Bloomberg's reporting, the administration and together with its allies are looking at actually hitting the Houthi rebels directly at the source in Yemen in order to cripple their ability to go after these commercial vessels. According to Bloomberg's reporting, no decision has actually been made. The administration still would like to pursue diplomatic channels here, but given the disruption in trade flows we are seeing and the real freedom of navigation that is in question, they are under increasing pressure to do more. The issue, John, are the issues potentially, though, are many. On the one hand, when we think about the Houthis, this is an Iran proxy. They are backed by Tehran, and the U.S. is really trying to keep the conflict between Israel and Hamas contained to just Israel and Hamas. They do not want this to spread into a broader regional conflict. The other consideration is the Arab allies. Saudi Arabia, for example, borders Yemen. They favor a much softer approach when it comes to dealing with the Houthis for fear of potential retaliation that the Saudis could deal with. So it's a very complicated situation to navigate at this point, John.
Simon, we're talking about how to make it better. How could it possibly get any worse?
Well, as Kelly just pointed out, the administration is at pains to avoid this conflict spreading into more of a regional war. But if we only go back up 4 years, the Houthi rebels actually struck into Saudi Arabia. You may remember they actually temporarily shut down something like half the kingdom's oil capacity for a few days there. The oil market remembers that very, very well. So the nightmare scenario for the oil industry is that the conflict does spread. There are potentially military strikes, as we reported yesterday. Those are under consideration. And the infrastructure becomes a direct target, and that will absolutely not just affect the flow of the oil, it could even stop some of the flow altogether.
We've got another nightmare scenario, potentially, Katie Lyons, for this administration. NBC reporting this morning, just a bombshell story, that Chinese President Xi Jinping bluntly told President Joe Biden during their recent summit in San Francisco that Beijing will reunify Taiwan with mainland China. This according to 3 current and former U.S. officials. Now, the timing has not yet been decided. Apparently, this is by peaceful means. Katie, what's the reaction in Washington to this one?
Well, as you said, John, this is a major story because, of course, it comes at a time when China is seen as becoming more aggressive toward Taiwan, but also a time when the U.S. is trying its best to normalize relations with Beijing. As you said, this is a conversation that took place just over a month ago in San Francisco. Yes, timing is uncertain. Yes, Xi Jinping said he would prefer that this happen through peaceful means, not by force. But this really underscores how difficult the Taiwan issue is for this administration, which still technically abides by the one China policy, tries to exercise strategic ambiguity when it comes to Taiwan. But President Biden has also been on the record saying that the U.S. would come to Taiwan's defense if attacked. Attack, of course, would implicate that it is actually an attempt to take it by force. But still, this idea, John, that China does intend to actually bring Taiwan back more solidly into the fold, it creates a problem for the U.S. that is really trying to be supportive of democracy in Taiwan, but is really reluctant to weigh in on the independence question.
Katie, thanks for the update. Katie, Simon, to the both of you, thank you. About 23 minutes into the session, your equity market pulling back by 0.1% on the S&P. Your trading diary up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Bloomberg.
drama here. Stock's a little softer. We're down 0.1% on the S&P. Let's get to the trading diary. This is what to look for today. President speaking at 1:45 Eastern on Bidenomics. Plus, Micron reports earnings after the closing bell. Thursday, US GDP, another round of jobless claims, followed by quarterly results from Nike and Carnival Cruise Lines. Friday, the bond market closing early for the holidays. That does it for me for 2023. From New York City, thank you for choosing Bloomberg TV. I say this every year, and every year I mean it a little bit more. 3 thank yous. Thank you for choosing to spend some of your time with me. I appreciate it. Thank you for being the most sophisticated audience an anchor could ever ask for. And thank you for making me smarter. I appreciate that too. Enjoy your families. Nothing else matters.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Frances Donald. She's the chief economist at Manulife. Get her call on this market, on this economy. And then we're going to get in some consumer confidence data coming out from the conference board. So we're going to check in with Dana Peterson. She's the chief economist at the conference board. And Bert Crouch, head of North America for Invesco Real Estate, discusses real estate prices, commercial real estate, and how a Fed pivot is affecting the property sector. So all that coming up in the next hour, and we're going to start things off, as we do, with a Bloomberg Business Flash from Nathan Hager.
We'll get some of that latest economic data just coming off the tape, Paul. December consumer confidence blowing past economist expectations at 110.7. The estimate was 104.5. And sales of previously owned homes unexpectedly jumped in November by 0.8%, led by a pickup in the South, a reprieve from a 2-year downturn caused by higher borrowing costs and lack of inventory. The reaction in the market, kind of mixed at the moment, but Chris Marangi, co-chief investment officer at Gabelli Funds, says a lot of the performance in stocks that we might have seen next year could have been pulled into the end of this year.
Obviously, the dovish tone from Powell last week really set off a party. It looks like the data is holding in there in terms of employment. So the Goldilocks scenario is back on the table. That is lower rates, perhaps a soft landing.
And we check the markets all day long here on Bloomberg. Right now, the S&P 500 is a little change to the downside. 4767 is the S&P level. The Dow Jones Industrial Average holding on to a decline of about 0.1% or 53 points, 37,505. The NASDAQ Composite is up 0.1%, up 16 points, trading at 15,019. 10-year Treasury is up 10/30 seconds, yield 3.89%. The yield on the 2-year, 4.38%. NYMEX crude's up 1.5%, up $1.11, trading at $75.04 per barrel. COMEX gold is down 0.2%, down $3.50 at $2,048.50 per ounce. The euro at 1.0965 against the dollar. The British pound 1.2667, and the yen is at 143.46. That's a Bloomberg Business Flash, and Bloomberg Markets is on with Paul Sweeney and
Emily Grafeo. How good is that?
Right?
Nathan Hager, thank you so much. Yes, Emily Grafeo is sitting in today. Welcome, Emily.
Thank you.
All right, we're going to have a good day. Should be in for the next 3 hours as we drive this bus forward. So Emily Grafeo, Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So just head over to that internet thing and search Bloomberg Radio and find where you need to go. Let's check in with Abigail Doolittle. She covers all the markets for us. She's here in our Bloomberg studio here in New York City. Abigail, what a move we've had here in the last 4 to 5 to 6 weeks. I was just looking at the Russell 2000, up 23% from that October low. So really showing, kind of a broadening out in the breadth of the market, which I know for a lot of folks is a positive sign for the health of the market.
It's pretty incredible, this rally that we've seen, and that Russell 2000 in particular basically moving into a bull market in that very short period of time. However, a bull market within a range. If you were to take a look at a chart of the Russell 2000 whipsawing over the last year between current levels and about 20% lower or so, we need to see these indexes break out of that range to know that there is new life. Today we have a little bit of consolidation. The S&P 500 slightly lower, fractionally lower. The NASDAQ Composite, on the other hand, slightly higher. It's interesting because everybody is focused on the Fed, the disconnect between the dot plots of 3 rate cuts next year and the street pricing in 6. Something else we need to start to factor in for next year and perhaps giving investors a little bit of pause today are earnings, because of course FedEx, they're tumbling. That stock's the worst since, I believe, 2020 or either 2020 or 2022. Disappointing profits. The outlook called vague by Citigroup. We also had weakness out of General Mills, and this is interesting. So, of course, General Mills, a cereal maker, they beat, but their outlook they cut, and they're saying that consumers are super cautious, that they're quote-unquote value seeking. So is this going to shape earnings in January? So that's going to be one of the first things we'll be paying attention to in the new year, to see whether or not this rally can continue, in addition to somehow narrowing that gap between the Fed and market expectations on cuts.
I was looking at a stat from Sentiment Trader, and it said that in just 33 trading days, the equal weight S&P 500 soared from a 52-week low to a 52-week high. Is there any sense that this broadening out of the rally is just happening too quickly?
That's a great question, and I love your stats that you have. You have some really great questions, very, very, very specific. So similar to the Russell 2000, I'll actually pull up the chart just to make sure what I'm about to say is correct. But basically going from the bottom of a range to the top of a range in 6 weeks. What has changed over that time period? Now, you can absolutely say that we have a confirmed Fed pivot. But again, you have this divide in terms of how much is the Fed going to potentially loosen next year. Are they really going to even do the 3 rate cuts? Are we going to have the soft landing? I mean, right now it's a soft landing, but will it be a soft landing next year? I mean, investors are really just blocking out all the uncertainty. And to me, it doesn't feel like climbing the wall of worry, because I don't think that there's anything too specific right now to worry about. But I do think that the animal spirits that have been stirred up over the last 6 or 7 weeks, it's probably not sustainable, even just from the standpoint of physics. If you take a look at some of these uptrends, they're almost parabolic. A parabolic trend by physics cannot hold. A 90-degree angle cannot hold.
Whoa. That's a good one. I haven't heard that before.
It's true. Take a look at gold. Take a look at Bitcoin. Anytime it goes straight up, you're at least going to see, I mean, you can see an equal and opposite move back down, Newton's third law, or it can be consolidation somewhere in between. So the question is, what is the new year going to bring? Some healthy consolidation, or are we going to see the elevator taken down?
What are strategists on the street saying about valuation here? Because during this move here, I haven't seen earnings estimates necessarily rise across this market.
It's high. It's certainly, it's interesting because I feel as though the street is pretty divided right now. For a little while, it felt like everybody was all of a sudden uber bullish, but now there is a fair amount, because of the degree of the rally, some folks are cautionary, and valuation is certainly a big piece of it. I'm trying to pull up the S&P 500 right now, unless, Paul, you actually know its PE for next year.
I'm just going to guess and say 21 or something.
Yeah, it's somewhere above 20. I'm pretty certain as well. I'm pulling it up right now. Yeah, so it looks like it's 20.
Yeah, 21. Yeah, right around 22.
So so I mean, that's like crazy high. What's the 10-year average? Like 16 or something?
Yeah, so some of the questions, though, a lot of folks will say, hey, you pull out the Magnificent Seven, and it's more like 17, 18 multiple, and things like that. So if you start making your adjustments there, so that's what I hear from a lot of bulls out there.
Yeah, but once you have to start justifying, I don't know, it makes me a little bit nervous. It should just be able to stand on its own. And plus, we do have the earnings season coming up next year. Now, if earnings don't follow in the trajectory of FedEx and General Mills, maybe it's going to be okay. But if we have other consumer staple companies talking about how consumers are seeking value, I wish I was seeking value. Maybe I need to do that myself. Or FedEx, not really being able to quite make the numbers. Amid difficulty, it could be an interesting first quarter.
Yep, absolutely. Abigail Doolittle, thank you so much for joining us. Abigail Doolittle, she covers all the markets for Bloomberg News, Bloomberg Television, Bloomberg Radio. We appreciate getting her time. Let's talk economics here. Soft landing, hard landing. I don't know, it looks like the Fed's trying to help us out here. We welcome Frances Donald here. She is the chief economist at Manulife Investment Management. She joins us live here in our Bloomberg Interactive Broker studio. We appreciate you coming into the office. So, Frances, what are you guys over at Manulife thinking about this economy? The market just in the last 5 or 6 weeks just said, this thing's ripping here. I mean, we have the yields on 10-year Treasury go from 5% to now less than 3.9%. I mean, what's your call on the economy for 24?
Well, there's a lot of questions in there, because if you ask me what do I think happens in the next month, we couldn't possibly have a better economic setup, right? You've got growth holding in there. The consumer hasn't given up just yet. Inflation data globally just coming in, downside surprises every morning when we wake up, and a Fed that said, you know what, we don't even need a recession to cut. We're ready to cut even into this soft landing. You get support for equities, you get support for bonds, just about every asset class does well there. But remember your investment horizon, because we are still looking at a material slowdown in the middle of 2024. Recession risk is still elevated. And even let's just throw out that term recession. Stop thinking about, is it 2 quarters of negative GDP, 1 quarter of negative markets don't care as much as headlines do. We're going into a growth slowdown middle year. So this is a tactical Goldilocks, a nice air pocket that you can trade. You can also still believe there's a recession on the horizon. Two things can be true at the same time.
The people who are calling for a soft landing right now, what do you think they're missing? What are they not seeing in the data that maybe you are noticing?
Right. Well, there's a whole difference of opinion as to, and this is the core question, is this time really different? Because if you look at the wealth of leading indicators that have traditionally helped you forecast a recession, every economist knows those are flashing red. The difference between those calling for a soft landing and those calling for a hard landing is really how much of a factor do you apply to saying there are things at play that are different than past cycles that will mute or mitigate. And frankly, even those shops that are calling for mild recessions, and if you look at a list of consensus calls, it's either soft landing or mild recession. You don't have very many who are actually calling for a traditional deep recession, and you don't have very many that are calling for this re-acceleration in 2024. But if you look at that, what they are effectively calling for is that the Fed is easing a little bit. This time is different. It's going to be very mild. So this is really a difference of opinion, not a difference of data sets.
How important is the labor market here? Because the labor market has just been incredibly resilient here. And we even had a tick down in the unemployment rate last month, which I don't think many people were forecasting. It's kind of tough to have a slowdown in the economy if everybody's got a job and rates and wages are going up.
A job-full recession. We had the jobless recoveries coming out of the GFC. Now this concept of job-full recession. But there's a few things going on there. One of which is you don't actually need the consumer to be in a recession for the U.S. economy to have 2 quarters of negative GDP. Okay. That can come from housing, CapEx. Let's not forget, manufacturing is in a recession. Yes, globally, we've actually had the longest manufacturing recession, one of the longest ever. So there are sectors and pockets of this economy, existing home sales.
Transportation companies will tell you they've been in a goods recession.
I don't have to convince anyone who's on the goods side of the business. I don't have to convince small cap portfolio managers that we're in a recession. They believe me. And frankly, I don't have to convince anyone in Germany, Canada, Japan, or outside the United States that we're in a hard landing. This is a U.S. story very specifically, and it's about services holding on. How much do jobs matter here? Well, one of the big challenges is jobs always break last, and they don't break in a linear fashion. It's a hockey stick, forgive my Canadian reference. It goes hard and fast upwards. And if you take a look at some of this underlying data like continuing claims, if you look at that big drop down in vacancies, the risk is that the unemployment rate rises. Now, when you're an economist working for a bank or the sell side, you got to come out with a forecast, you got to come out with conviction. When you're in a role like mine, you work with portfolio managers every day, they don't really care what my point forecast is. They want to know what is the balance of risks. And the risk is not that the unemployment rate declines and the job market strengthens from this point, it's that the job market weakens. And it's really asymmetric risk going into 2024. Does it matter for the economy? Absolutely. But here I would say this is the difference between that mild recession, soft landing, and a worse recession. It's not about upside, it's about what downsides are not being recognized.
So then against that, what do you make of all of the Fed speak that we've seen recently? I mean, first, Powell kind of not pushing back on that idea that financial conditions have loosened. And then in the wake of that, a few officials coming out and maybe trying to walk back those expectations just a little bit.
Yeah, you know, we're always trying to get a sense of what exactly is the Fed watching, as if they sit in a secret room. Well, I guess they do have a little bit of a secret room, and they have this magic formula, and we're all just trying to guess exactly what that magic formula is. I don't think it's that at all. I think just like economists and strategists and portfolio managers, the weight that they put on different factors changes. But again, if I'm sitting at the Fed, what is the balance of risks? Here's a risk that I haven't heard anybody talk about: downshooting on inflation, sub 2% inflation. Why are we not talking about that risk when we see this material decline in inflation expectations, energy costs? There's a wide range of goods prices that are dropping really quickly. That's not my point forecast, but it's a risk that needs to be assessed and has to be taken into account by the Fed. At the end of the day, I don't know how much it matters why they pivoted. It just matters that, as I've been saying, the toothpaste is out of the tube. It's real hard to walk it back. And I hear every day, oh, but they're pushing back. They're saying they're not talking about rate cuts. Well, how come every day I turn on my news, my Bloomberg terminal, and I see all the talk about how we're not talking about rate cuts? It's too late. And even, you know, the ECB and the Bank of England, they try to push back as well. The market says, we don't believe you. We don't believe you because you get UK inflation this morning that just says you can walk that talk as much as you want, but the data is not supporting that we are not in a disinflation and growth slowdown type of environment.
Stepping back a little bit from a global perspective, how concerned are you about China? Because it's just been a lot of soft data coming out of China. The reopening wasn't what I think a lot of investors anticipated at the beginning of 2023. As you look forward to 2024, how do you feel like China is going to impact maybe the global economy, the U.S. economy?
Yeah, so we think about China in terms of fat tails. And by that, I mean that the distribution of risks on both the downside and the upside are quite large. So on one hand, as I said earlier, we're talking so much about soft landing, hard landing in the United States. The rest of the world is already in hard landing territory. Emerging markets led interest rates higher coming out of COVID, and they are now actively cutting. China is in a very significant fiscal and monetary easing cycle. We've got a range of emerging markets that are already in easing. The Fed and the rest of the developed market central banks are laggards when it comes. They will be the last ones to go. So following China through this disinflation, I think, is really clutch. And let's also remember, China is in deflation. They have negative CPI right now. So they are a really important leading story. What I think is telling about China is that they've put the pressure on the fiscal side to ramp up support. That's an upside risk to the global economy, but fiscal doesn't impact your economy overnight. So that's more of an upside risk to later 2024 into 2025. When you look at the lags between Chinese economic activity and U.S. economic activity, China's slowdown becomes very impactful to the United States in the next 6 months.
Right, interesting. And just we had some data that just came out at 10 o'clock today. The Conference Board consumer confidence came in much better than expected. So the consumer still hanging in there.
Good. You know what the consumer loves? Lower gas prices.
Yes. Mm-hmm. Yep.
How interesting is it that we are always talking about, the central banks, they have to contain inflation expectations. I worked at a central bank, and when I did, I told some friends, and they said, "Oh, you must be a bank teller." And I tend to think about that because the perception is that what a central banker does meaningfully moves inflation expectations, and that's true in some components. But if you track where consumer expectations are for inflation, they just track on top of gas prices. That's what people see over time.
And I can tell you it's $3 at the Wawa in Wall Township. Francis Donald, thanks so much. We appreciate it. Chief Economist, Manulife Investment Management, joining us live in studio, even after being live on television earlier today. So we appreciate that commitment. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Expectations were high, but FedEx's profit fell short of forecasts, and shares are certainly feeling it. Bloomberg's Kriti Gupta has analyst reaction.
Are basically saying that there's a lot of revenue disappointment in their express business, which is really reliant on their own network at a time when they were really kind of amping it up. If you look at their ground and their freight businesses, profit beats, but it's the fact that their biggest business, the one that they really put their weight behind, those are the ones missing their revenue estimates, pushing the stock down.
So how much lower right now? Well, FedEx shares are down about 10%. Sales of General Mills, well, they fell short of estimates. Bloomberg's Simone Foxman says it's all about volume problems.
Organic net sales unexpectedly dropping about 2%. The expectation is that they would be higher by close to 3%. Particular weakness among the pet food sector. And when you look at the overall volumes, the amount that General Mills sold, it was down 4% since last year. This all resulting in a lower outlook for the fiscal year 2024 that ends in May.
General Mills right now down about 2.5%. And TikTok's e-commerce business is driving growth. Sources tell Bloomberg sales at its Chinese owner, ByteDance, jumped 30% in 2023 to more than $110 billion, possibly topping the projected growth of social media rivals Meta Platforms and Tencent Holdings. Now that's despite tough economic times in China and elevated restrictions in key markets from the U.S. to India. An electric scooter rental pioneer, Bird Global, losing its charge. The company, which rents vehicles in several cities, has filed for Chapter 11 bankruptcy. Those are the company stories we're following this hour. I'm Lisa Mateo.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 10:22 on Wall Street, I'm Nathan Hager. Treasuries are trimming some of their gains. Stocks are trading flat after the latest batch of economic data on existing home sales and a jump in consumer confidence. We check the markets all day long here on Bloomberg. Right now, the S&P 500 is up 2 points. The Dow is down 27. The NASDAQ Composite is higher by 48 points. That's a gain of 0.3%. 10-year Treasury is up 7/30 seconds now for a yield of 3.90%. The 2-year is at 4.40. NYMEX crude's up 1.4%, up $1.03 at $74.97 per barrel. COMEX gold is down 0.3%, down $6.60 at $2,045.50 per ounce. The euro 1.0961 against the dollar, the pound 1.2671, the yen 143.56. Apple says its card, cash, pay, and wallet services are experiencing outage issues. That's according to the company's system status page. Not a whole lot of effect on the stock on that news. Apple shares right now are higher by about 0.25%. That's a Bloomberg Business Flash. Bloomberg Markets continues now with Paul Sweeney and Emily Graffeo.
All right, Nathan Hager, thank you so much. We appreciate that. Emily Graffeo, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so check us out there. Conference Board came out with some consumer confidence data, just kind of much better than expected. 110.7 was the print. The consensus expectation was 104.5, and last month it was 102, so just a strong number any way you look at it here. So let's break down some of these numbers. Dana Peterson joins us. She's the chief economist at the Conference Board. Dana, what's behind those numbers?
Well, I think consumers are saying that inflation's not as bad as it was, especially gasoline prices. Yeah. They're also probably heard in the news that mortgage rates are down, and also the Fed's probably done raising interest rates. So I think a combination of those things really fed into consumer confidence in the month.
What about the expected inflation? I mean, is that an encouraging sign that now consumers are bringing those expectations for inflation lower than they were?
Absolutely. The fact that inflation expectations 1 year ahead are lower is really important. And again, it tends to follow food and energy prices. Now, there's still complaints in the write-ins about food and energy prices and inflation in general, but the good news is that they're seeing some progress. They're seeing the Fed's work being borne out in everyday activities.
Dana, so you kind of put some of this together here, and we've had, just probably since the last time we chatted, we've had this Fed pivot where the Fed's now maybe entertaining a little bit more seriously rate cuts in 2024. You put all that together. You guys at the Conference Board, what's your economic outlook for 2024? Is it a hard landing, soft landing, nothing? How do you guys think about that?
Well, we do think that we could have a soft patch in the first half of next year. It could even be a mild recession that's pretty brief, and then we get out of it in the second half. With all of that, we think the Fed will probably cut interest rates by about 100 basis points and probably won't get started until the middle of 2024.
What would be the catalyst for something that would prompt the Fed to cut more than just 100 basis points?
I think the key measure is inflation. So right now they still expect that inflation's probably going to return to the 2% target in 2025, but they did downgrade their forecast for inflation for 2024, and that added on another 25 basis points of easing to the summary of economic projections suggestions about the Fed funds rate. So I think all that's important. If inflation falls faster than expected, then the Fed can certainly cut more than what's suggested in the SEP.
Dana, I guess in October, student loan repayments began once again for a lot of folks. Are you seeing that in any of the data that you're looking at in terms of consumer confidence and just the health of the consumer?
I mean, it's hard to tell. We do ask consumers, and we do look at the data cuts by age and also income. And certainly in December, just about everyone was happier, and including that group that the age 35 through 50 that tends to have most of the student loans. So I think that, a number of the reprieves that have been coming out from the administration and maybe some refinancing has been helping out consumers there. But we still have a lot of student loan debt that needs to be paid. And then consumers have been piling up money or debt on credit cards and also using buy now, pay later schemes. And all of that is introducing a lot of debt that's going to have to be paid at some point. But it also has a much higher carrying cost given the fact that interest rates are 525 basis points higher than they were almost 2 years ago.
Yeah, is any of that showing signs of worry right now? I get a lot of strategist notes talking about how delinquencies are rising and consumers are using more credit. But is it a sign, is it a cause, a reason to worry, I guess?
I think it is a reason to worry, and it folds up into our expectation that we will have this short and shallow recession in the first half. So consumers are not going to see their wages rise as much. You're not going to see as much churn in the labor market, so people are going to sit tight and maybe not spend as much. And then consumers are going to have to pay back that debt. And we are definitely seeing delinquencies go up, especially 90 days or more. And you're noticing that charge-offs for banks, especially small and medium-sized banks, are on the rise. So that's also putting upward pressure on the banking sector. So I'm very concerned about a lot of the debt that's being piled on by consumers right now.
I mean, and we've seen that, but it doesn't seem to be, I don't really see it in too much of the numbers, although we had Federal Express today come out with earnings and saying, they're seeing lower demand for their services. And then we were talking to an earlier guest who says, hey, we've been in a goods recession for several quarters now. So but that doesn't seem to be impacting the consumer very much.
You're right. Certain industries have been in recession. Certainly, certain aspects of manufacturing, transportation, and also warehousing because they're moving the packages. Also, when we look at the technology and financial sector, so those sectors, yes, have been having a hard way to go. And the thing is that, you have seen some layoffs there. But the key thing is many companies are not looking to let people go. Why? Because they spent tons of time and money trying to attract and retain that labor during the worst of the pandemic and then also during the recovery. They don't want to let all those people go unless they absolutely have to. So the fact that more people or that many people are still working is key. But certainly if we start to see less churn in the labor market, less hiring, and even more layoffs, then you could see consumers respond to that. And we think that's going to be happening. That's going to definitely happen in the first 3 to 6 months of 2024. So
where do you think that unemployment number rate could go? Because we actually saw it unexpectedly tick down last month to 3.7%. Do you think that could go north of 4, maybe 4.5%?
Well, our forecast is for the unemployment rate to rise to 4.3%, probably around the middle of next year or in the third quarter.
All right, very good. Dana Peterson, thanks so much for joining us there. Dana Peterson, Chief Economist for the Conference Board. Again, kind of going through those numbers that came out today. The Conference Board consumer confidence came in at 110.7, well above the consensus of 104.5. The Conference Board survey of the present situation. How are people feeling about things right now? That came in at 148.5, a strong number compared to 138.2, or actually revised 136.5 from last period. So big jump there, big jump. And for expectations, how do consumers feel about the future? A big increase month to month. 85.6 was the reading, and last month it was revised 77.4. So a big jump there. So again, I look at the price of gasoline, as a couple of guests have pointed out. And again, I'm filling up the Beamer down at the Jersey Shore for $3. That's pretty good.
What if it adds to inflation, though? People then go spend on other goods and services because they're not spending as much on gas. That's what I'm worried about.
But I don't know. I would say that's good for the economy. I'm going to go out and buy stuff. I'm going to go out and buy services. Maybe maybe go to a Duke game tonight at Madison Square Garden against the Baylor Bears. I could
buy a $25 beer.
Exactly. Very, very good. So we'll see. But UVA, are they fielding a basketball team this year?
Yes.
And are they any good?
Yes, they're good. I went to a game a few weeks ago. We had like a 30-point lead over Syracuse.
Where was that game?
John Paul Jones Arena.
Oh, you went down to Charlottesville?
Mm-hmm. Yeah.
Now, did they fill that arena?
It was a sold-out game.
Okay.
I was in the nosebleed seats. So from my view, it looked like it was pretty.
So does UVA typically sell out their home games?
I don't know the data on this. But
you don't know the data on this. They built this beautiful indoor stadium for the hoops, and you don't know. See, very easy for Cameron indoor stadium. We sell out every game, always.
It's usually a packed stadium, I will say. There's a lot of donors. in there, a lot of adults.
Yes.
I think there should be more students, but I
So
don't
you
know
don't-
if UVA makes it easy for the students to go to these games.
So the UVA students don't camp out all season.
Not like the Duke students. I wish there was more camping out, but I think they can't actually get tickets. I'm not really sure. I never had to worry about that.
In
so.
football, you guys are not going to a bowl game this year, right?
I don't think so. No.
I don't think so. You didn't even get close to 6 wins. I don't think so. No. Duke, however, is going to Birmingham, Alabama. How about that for playing the mighty Duke football? All right, let's get a quick look at this market before Michael Barr jumps in here and ruins it all for everybody. S&P 500 up about 0.1%. The Dow pretty much unchanged, only down about 23 points here. NASDAQ up 0.4%. So again, on the indexes, it feels like not a lot happening there. On the yield front, a little bit pullback in the yields here. The 10-year Treasury is off about 3 basis points, 3.90%. Remember when we were at 5% just 4, 5, 6 weeks ago? Big move in rates there. WTI crude oil, it's up another 1% today. So again, the continued tensions in the Red Sea pushing up price of crude oil on supply concerns there. Bitcoin up about 4% today, 44,175. So Bitcoin, I'll call that out for Tom Keene because he's a big fan, we all know. So we'll see how that plays out going forward. And Brent crude, just the European crude, 79, just under $80 per barrel. So a lot of movement there. With our news in New York City, here is the aforementioned Michael Barr.
Paul, Emily, thank you very much. A divided Colorado's U.S. Supreme Court, or the Supreme Court declared that former President Donald Trump is ineligible for the White House under the U.S. Constitution's insurrection clause and removed him from the state's presidential primary ballot. Julie Norman is co-director of the Center on U.S. Politics at University College London on whether we could see other states follow suit.
There's many who I think believe because this Colorado ruling is now out there that it might, encourage, embolden other courts to rule similarly. Other states that have looked at this question, New Hampshire, Michigan, Minnesota, have not chosen to move forward with it. But I think that this ruling will open the doors for other states to say, okay, we have this precedent from Colorado. We can look at what their logic and ruling was. What are we going to say about it?
Julie Norman at University College London says the case will likely go to the U.S. Supreme Court. Defense Secretary Lloyd Austin confirms that since its announcement yesterday, a number of nations have reportedly reached out to get involved with Operation Prosperity Guardian to protect the Red Sea from increasing Houthi attacks. Austin called the strikes irresponsible and dangerous to the entire global economy.
You know, what the Houthis are doing affects commerce around the globe. You know, some 10 to 15% of global commerce flows through the Red Sea and through the Straits. So freedom of navigation is important to, again, countries around the globe.
U.S. lawmakers who have been in an impasse over more than $60 billion in fresh assistance for Ukraine as its war with Russia approaches its third year abandoned efforts to reach a deal before leaving Washington for a holiday break. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
$10:40 on Wall Street. I'm Nathan Hager. Treasuries are holding on to gains. Stocks are struggling to resume their climb. The latest batch of economic data has traders measuring the chances of a soft landing. Consumer confidence came in way better than expected from the Conference Board for December. Existing home sales unexpectedly jumped from a 13-year low last month. But Manulife Global Chief Economist Francis Donald says there are risks to the economy next year.
You're still looking at a material slowdown in the middle of 2024. Recession risk is still elevated. And even let's just throw out that term recession. Stop thinking about, is it 2 quarters of negative GDP, 1 quarter of negative markets don't care as much as headlines do. We're going into a growth slowdown middle year. So this is a tactical Goldilocks, a nice air pocket that you can trade. You can also still believe there's a recession on the horizon. Two things can be true at the same time.
You can hear more of Francis Donald's thoughts from Manulife on today's edition of The Tape podcast. Right now, the S&P 500 is up 4 points, a gain of 0.1%. The Dow Jones Industrial Average is down 27 points. That's a decline of about 0.1%. The NASDAQ Composite is up 56 points, or 0.4%. 10-year Treasury is up 6/32, yield 3.90%. NYMEX crude is up 0.8%, now trading at $74.49 per barrel. COMEX gold is down 0.2% at $2,047.40 per ounce. The euro, 1.0974 against the dollar. The yen is at 143.55. Just got this headline. SiriusXM is being sued by New York Attorney General Letitia James over, quote, a frustrating cancellation process. SiriusXM shares are up about 0.4%. In the interest of transparency, we should note that Bloomberg Radio provides programming to SiriusXM satellite radio. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Emily Grafeo.
All right, Nathan Hager, thank you so much. We appreciate that. Emily Grafeo, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. Let's talk a little real estate here, particularly in the context of maybe we've seen peak rates, and maybe rates are going to come down. Mortgage rates are starting to come down pretty substantially. I look at MB, as in boy, 30 go on the Bloomberg terminal, and that gives me kind of where we are. Well, I didn't see it right there. But anyway, we'll find it in a minute. Yeah, that's a 30-year contract rate, and it's 6.83% for a 30-year fixed mortgage. So the peak was, just a couple of months ago, back at 7.9%. So a big move down in mortgage rates, still high by long-term standards, however. Bert Croucher joins us. He's head of North America Invesco Real Estate. Hey, Bert, talk to us about kind of what you're seeing across commercial real estate in the U.S. here. The office business is really, really tough, but there's lots of other areas where it's still pretty good. What are you seeing out there?
Yeah, look, the industrial space continues to be relatively strong. The e-commerce trends continue, but they're decelerating. We saw vacancy, reach an all-time low of sub 4% in the space, and it's now ticked up to north of 6%. So I'd say levels are starting to normalize, but Paul, we started from such a position of strength that on a relative basis, they're still good. The surprise is retail. Omni-channel is something that retailers have realized they really need. The experiential aspect is what consumers really want. So with the lack of new supply, which is different than what we're seeing in apartments and industrial, we've seen vacancy actually drop and now below historic averages. The one that we're watching is apartments. We've seen an influx in supply that has pushed vacancy up a little bit and started to turn rental rates despite the affordability argument for rent versus buy and some of just the general shortages we're seeing in housing generally across the U.S.
So, Bert, how has the market's expectations now for a Fed pivot affected the outlook for commercial real estate heading into next year?
Yeah, Emily, it's been fairly significant. We had already seen REITs, public real estate investment trusts, start to move fairly materially in the fourth quarter, and then Powell's pivot last week was a game changer there. We saw those rip across the board. They're now trading close to their net asset value, which is the historic norm. They're up about 15%. And what that means is when you think about how real estate On the commercial side is valued, it's a cap rate, which is basically the inverse of a PE multiple. And so if you look at it that way, it's in about 100 basis points. If you flip it to what a lot of your audience would equate to, the multiple's gone up from mid to high teens to something in the low 20s. So the outlook is improved materially. The 10-year Treasury, Paul, as you were talking about to start the segment, in the last 60 days, going down 100 basis points. That psychological threshold north of 5 to south of 4% is material. Looking at the forward curve, Emily, to your comment about the Fed now, a year from now, breaking 4%, at least that's the market's expectation, that's significant. You put all that together and you think about the over allocation that we were looking at this time last year to real estate. You've had the S&P up over 20% on the year, NASDAQ up over 40, most fixed income up across the board, and real estate values starting to fall, starting to normalize. It has put the institutional allocation back in a positive light. Most are neutral or underallocated. So it sets up fairly well for 24.
If I want to go out and buy a building or develop, apartment complex, can I even get the money? What's the state of the capital markets in the real estate biz these days?
Yeah, it's more dislocated than it's been in a long time. I can argue back to the global financial crisis. What we saw in the mini banking crisis started by Silicon Valley Bank at the end of the first quarter really shone a light on the overexposure that a lot of the mid-sized banks had, that kind of 100 billion to 250 billion in asset range. And we've since seen the new Basel III endgame regulations come out to put a higher tier 1 capital allocation to commercial real estate loans. Paul, we saw today that the FDIC put out a new advisory to banks to be cognizant of their commercial real estate exposure. So to answer your question, we've seen a significant pullback by the regional mid-sized banks, which were the primary provider of development financing. And again, it's another one of the optimistic signals. While I would say that there is some oversupply, take apartments, we're expecting another 900,000 plus units to be delivered over the next 12 months. The pipeline beyond that is very, very small on historic standards. Primarily to your point, you've got a limited availability of financing. What financing you can find is expensive. Costs are still elevated and exit values are uncertain. So it creates a pretty attractive supply-demand picture 25 and beyond.
Okay, so what's your highest conviction idea for next year?
Yeah, it's the question to ask. I would tell you, and this isn't dissimilar from what you're hearing, generally speaking, across the board, and I'd argue dovetails to Paul's comment. We built the firm. This is our 40th anniversary this year. We built it around location, which is an overused adage in real estate, but it rings true no matter what your strategy is. I would tell you, though, we've really pivoted to the credit mantra this year. To the question a second ago, commercial mortgage-backed security new issuance is through the floor. Banks, money center, or regionals are not lending. And rates generally, if you can get a loan, are high. So our highest conviction is in alternative lending. It's a best of both worlds scenario today. And what I mean by that is historically what happens when you have a dislocation, you have the Fed drop rates to zero to stimulate the economy. And in this case, we have the exact opposite. A pandemic to stimulus to inflation to the rate response that drove the dislocation. And so for our credit strategy, why that's so attractive is we have wide spreads at the same time. We have high base rates. So the punchline is I can lend to institutional sponsors on institutional quality collateral, conservative metrics, get a low double-digit floating rate cash-on-cash return, and I can do it with limited volatility, high Sharpe ratio, and a fairly low correlation to real estate or fixed income alternatives. So it fits in a portfolio well. It gives you comfort that you don't have to predict the market to be right, i.e. not lose money and generate an attractive return, and that return is all current income.
Bert, good stuff there, my friend. Bert Crouch, head of North America, Invesco Real Estate. And he is a Longhorn from the University of Texas. They got a good football team this year. I think they're back, baby. University of Texas. Bert Crouch, head of North America Invesco Real Estate. Talking about a little commercial real estate there. There are ways to play it. I'm interested to see how the office space when we start seeing some transactions in big markets like New York and other markets, kind of what the discount really is out there for commercial real estate. I think it's going to be pretty substantial. This is Bloomberg. All right, let's get some company news right now with Lisa Mateo.
You got it, Paul. After a dramatic year of deal-making drought, job cuts, and collapsing lenders, bonuses for traders will be much slimmer in the new year. Bloomberg's Abigail Doolittle has the breakdown.
JP Morgan is one of these big banks that is basically, it's expected that their bonus pool will stay flat to next year. Citi, the biggest restructuring in more than a decade, their bonus pool could actually decline a little bit if it doesn't stay flat. Goldman and Bank of America, on the other hand, there is a chance that some of their traders may see their bonuses rise by a couple of percentage points.
Checking in right now, JP Morgan and Bank of America, they're up about 0.1%. Goldman Sachs and Citigroup right now are a little change. And some salaried workers at Tesla have been told by their managers that there will be no merit-based equity awards this year. They tell Bloomberg that they think the move was widespread. Now, the workers did still get a cost of living increase to their base salaries. No comment from Tesla, whose shares are up about 0.2%. And an airline carrier is making some headwind with its pilots before the holiday. We get more from Bloomberg's Gina Cervetti.
Southwest Airlines pilots have reached an agreement in principle on a new 5-year, $12 billion contract with the airline. The union for about 11,000 pilots at Southwest declined to disclose further terms, but the airline is the only one of the 4 largest U.S. carriers that has not signed a contract this year.
Southwest up about 0.7%. And the actors and writers strikes of 2023 will continue to hurt Hollywood in 2024. An analytics company predicts North American theater ticket sales will be down 11% next year because of a drop in the number of new films. Right now, AMC, Cinemark, they are lower. Those are the company stories we're following.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets here, not a lot of movement at the index level. The S&P is pretty much unchanged, as is the Dow. The Nasdaq getting a little bit of a lift, up about 0.3%. Yields coming in just slightly. 10-year Treasury off about 2 basis points. 3.91% is your yield on your 10-year Treasury. On the commodities front, WTI crude oil up about 0.9%, $74.60. And Bitcoin seeing a nice move higher here today, up 3.9%, 44,150 on Bitcoin. That's the quote for Tom Keene right there. With our news in New York City, here's Michael Barr.
Thank you very much, Paul and Emily. The Colorado Supreme Court has ruled that Donald Trump cannot appear on the presidential primary ballot in that state. More with Bloomberg's Ed Baxter.
The ruling, while at the same time pausing it to allow the U.S. Supreme Court to rule. The Colorado court said under the 14th Amendment, Trump qualified as an insurrectionist and therefore cannot hold office, thereby taking him off the ballot. So among the issues for the highest court, whether Trump is actually an insurrectionist and whether the 14th Amendment refers to the office of president. Trump's attorneys say they will appeal, and his campaign has issued a statement, so reading verbatim here, unsurprisingly, the all-Democrat appointed Colorado Supreme Court has ruled against President Trump supporting a Soros-funded left-wing group's scheme to interfere in an election on behalf of crooked Joe Biden. Verbatim from the statement. Ed Baxter, Bloomberg Radio.
More than 100 container ships are taking the long route around Africa to avoid violence in the Red Sea, creating extra costs and delays. It comes as the Pentagon established a multinational naval task force to protect commercial ships from Houthi missile and drone attacks in the Red Sea and Gulf of Aden. Such attacks have escalated in the wake of the Israel-Hamas war. State Department spokesperson Matthew Miller.
There is no justification for these attacks on global commerce, and we hope the world will join us in condemning these attacks and working to stop them.
The task force, named Operation Prosperity Guardian, involves 10 nations, including the UK and Canada. Doctors are growing increasingly concerned with drugs used to treat conditions like ADHD, diabetes, and even cancer, facing chronic shortages nationwide. Experts blame the shortages in part on the low cost of generic drugs, with insurance companies often only paying for those cheaper generic versions. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Emily.
Hi, Michael Barr, thank you so much. We appreciate it. Emily, here's a story that is interesting on the Bloomberg terminal. Sick shaming, which I didn't know there was such a thing. So sick shaming, in quotes, pushes Americans to take too much cold medicine. Pressure to return to work, but cautious about seeming sick, U.S. employees are loading up on over-the-counter cold and allergy medicine. So in the U.S., sales of upper respiratory over-the-counter medicine rose 23% to $11.8 billion in the 52 weeks through early December from the same period in 2019 before the pandemic, according to researcher NIQ. Cold and flu treatments would make up about a quarter of the category, grew faster with a 30% gain. Has your kind of back-to-work personal thought about, do I come, do I go to work, do I not, has that changed?
It has. I've never heard of the term sick shaming until just now, but I do feel like post-COVID, there are more side-eye glares when people in the office cough. And so I understand these people in this Bloomberg article loading up on cold medicine to mask their allergy symptoms because they don't want people to think that they're contagious and sick. So they're taking way too much Benadryl.
At Kenvue, which was spun off from Johnson & Johnson earlier this year, over-the-counter drugs such as the allergy treatments Zyrtec and Benadryl and decongestant Sudafed generate about 40% of revenue. Sales at the division housing those brands rose 10% to $4.9 billion for the first 9 months of the year. By far, the company's top-performing unit. So maybe the data is true, proving it out.
I wonder if people are drinking more coffee, too, because these medications make you very drowsy at work.
Interesting. Okay, we'll have to play that out. I mean, here, I don't know. I mean, here in a little radio studio, we're particularly sensitive to this kind of stuff if you come into our little hermetic world here. All right, we'll stay on top of that one. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up, we're going to kick off this hour and get a look at the markets with Abigail Doolittle. Plus, we're going to check in with Caroline Frederickson, distinguished visiting professor at Georgetown Law, to discuss former President Donald Trump getting disqualified on the Colorado ballot for 2024 and how this might play out in the Supreme Court. And then we'll talk a little fixed income here. Lisa Hornby, head of U.S. multi-sector fixed income at Schroders. She'll give us her call here for fixed income. Thomas Martin, senior portfolio manager at Globalt Investments, joins the show to discuss market trends and investing strategies as he gets ready for 2024. But first, let's go to Nathan Hager down in Washington, D.C., get a Bloomberg Business Flash.
Well, stocks are trying to push through, Paul, after we got some of the latest economic data, some positivity once again. Consumer confidence, as measured by the Conference Board, blew past a lot of economists' expectations, and existing home sales had an unexpected jump last month as well. But honestly, this market has really been rallying ever since the Fed kind of signaled to markets that rate cuts could be coming next year. Amy Wu Silverman, head of derivatives strategy at RBC Capital Markets, says market's looking pretty one-sided right now.
There's a lot of overwriting in the market. It's suppressing volatility. We all know that technically. The question is, does the party stop? I think most folks think it doesn't stop. But of course, equity strategists like myself remember 2008, 2018, March of 2020. And that's always been the question of whether those dynamics start to break.
You can hear more from RBC Capital's Amy Wu Silverman on the Bloomberg Surveillance Podcast. And we check the markets all day long here on Bloomberg. And right now, the S&P 500 is up 4 points. 47.72 is the S&P level. The Dow is down 7 points at 37,550. The NASDAQ Composite's up 50 points, trading at 15,053. 5 of the 11 main industry groups in the S&P are in the green, led highest by communication services. Consumer staples is the biggest laggard right now. 10-year Treasury's up 5/30 seconds, yield 3.91%. The 2 years at 4.39%. NYMEX crude is up about 1%, $74.73 per barrel. COMEX gold is down 0.3% at $2,045.80 per ounce. The euro is at 1.0975 against the dollar. The yen is at 143.70. Last hour, I told you that Apple was reporting a service outage with its card, cash pay, and wallet services. Well, now Apple says that issue has been resolved. Didn't see a whole lot of movement for Apple stock on that headline. And we continue to watch Sirius XM shares. New York is suing the satellite radio provider over its cancellation policies. Sirius XM right now is down 0.1%. And in the interest of transparency, we should tell you that Bloomberg Radio does provide programming to Sirius XM satellite radio. That is a Bloomberg Business Flash, and Bloomberg Markets continues. Here's Paul Sweeney and Emily Grafeo.
All right, Nathan Hager, thank you so much. We appreciate that. We've got a roaring debate going on here in the studio. Abigail Doolittle joins us to talk about the markets. It goes back to, as Nathan was saying, about the Apple story and Apple Pay and all that stuff. And I just pulled out a wad of cash, which I always carry with me because you never know when you're going to pass by a craps table. But the kids today, which I'm going to put Emily Grafeo, who's a recent college grad several years ago,
Yes.
And I have offspring that same age, they don't carry cash. And Abigail and I were like, well, they're not even like $20 for an emergency?
Sometimes I don't even carry my wallet because I have my phone in my hand and I can use Apple Pay, which that's been a problem.
I have Apple Pay. I can't use my phone.
You don't have Apple Pay?
I do
All right,
not.
you're the...
So I still watch DVDs, even with the demise of Netflix.
And can we disclose your Netflix?
Yes.
All right. So Abigail, we'd go to the mail slot right in our little floor here in Bloomberg Radio and TV, and there'd be a lone Netflix. And this is as recent as 6 months ago?
Well, I mean, it was heartbreaking to me when they hung up the, and I just had to buy through Amazon The Crown Season 5, Downton Abbey Season 6, which I've already seen, but I want the complete collection.
Prior to a few months ago, you were
Tinker,
still doing the
Soldier,
Netflix.
Spy. Oh, yes, religiously. I was on the...
I didn't know they still had that 6
That's
months
even
ago.
more
But
shocking
do you
than
want to
not
know
owning
something
cash.
more shocking about Netflix discs, and then we'll get to the markets, is the fact that you think as streamers you
Yes.
get more content. It's absolutely not true. The content, to some degree, is being chosen for you. The first time I ever streamed Netflix, I was like, well, this is a short. There was like 100 choices on there. Netflix discs, there was like the whole world. I mean, there are going to be great movies from 20, 30, 40 years ago that people just won't be seeing because they're not going to be streamed. So that's one. And then something else. What about that paper Wall Street Journal I'm reading every morning, and people are like, oh my gosh, are you reading a paper?
I actually do like reading the paper.
Yeah,
That's
it's so
my
satisfying. And
intake,
for me, I take in a lot more than online.
All right, well, speaking of Apple CarPlay, Bloomberg is now on your dashboard with Apple CarPlay and Android Auto. You see how we did that? It gives you access to every Bloomberg podcast, live audio feed from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, the good news is it's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers. All right, so we established that the kids don't have cash, and Abigail's just coming into the streaming technologies. But
I'm fighting it.
I know, but she is absolutely our go-to person on all things market. So, Abigail, not much action at the index level here today. What are you looking at under the hood?
Under the hood, there is a fair amount of action. FedEx down nearly 11% this after their profit. They missed, essentially. They missed sales by 1%, profits by closer to 4%. The outlook called a little bit disappointing. Volumes are down. General Mills, I don't see it in my S&P 500, but the last time I looked, it was down. And this one's super interesting to me. We were talking about it last hour, and the reason I think that we should talk about it again, FedEx worth talking about again, just because it's such a broad picture of the economy or changing habits. But General Mills, they beat, but they cut their outlook, saying that folks are being much more cautious. So when Americans are being cautious around their cereal buying, that they're value oriented or other type of staple foods.
Well, I'll tell you what I do just in my personal shopping in the last 3 or 4 years is trade it down, or I'm not even sure it's traded down. I've switched from brands to store brand.
Well, sometimes the store brands are better. Sometimes it's product by product.
Well, the price differential is on a percentage basis is amazing.
Is it
I've
huge?
never even thought
I need to do that more, I think.
Yeah, I mean, some stuff, I go brand, like, Skippy peanut butter. I'm not going signature brand.
Some, like Whole Foods 365, some of their generic brands are actually better than the real brand. But in any case,
if you're General
Mills,
you see that.
take on it is not so much about it. They're just calling it overall value. And someone like you, if that's something that you're doing, it kind of makes that point. To the upside, on the other hand, we do have Alphabet up 3.2%. More details came out on a settlement over their App Store with 3 dozen states and potentially more than 1 million consumers of, I believe it was $700 million. That's separate from the Epic lawsuit that they lost, perhaps setting a precedent for some other sort of settlement in the future, but clearly broadening out. And in addition, they are broadening out, they're planning changes to their ad sales. It looks like there could be some restructuring, and so folks are excited about that.
Stock's up 60% year to date.
Incredible.
52-week high, $700 million is like 15 million minutes of free cash flow for them. And that's been the story with U.S. technology companies and regulation for 30 years.
Well, you know what's
Microsoft.
amazing? So Alphabet is up that huge amount, which is very impressive. But when I compare it to NVIDIA, which obviously they're two different technology companies, NVIDIA's up 241%. It's like a penny stock, and yet all that AI play.
Yes, and I don't know what the AI story is. There will be one, but what the AI story will be for 2024.
It's going to be interesting to see whether or not the air can stay in the balloon. I think that there's a lot of disbelievers. I am not an expert on the space, but my thought pattern, my logic on it would be that it's going to be similar to the internet. It's real. It is going to change the way that we live, but there's going to be a lot of losers, for lack of better, like pet.coms that are going to get sorted out, and there will be a moment of reckoning where even the NVIDIAs and the other ones who are very legitimate could, kind of go out with that bathwater.
I was interviewing yesterday John Butler, who's a telecoms analyst at Bloomberg Intelligence, and he brought a topic that I haven't heard in a couple of years.
Oh, wow.
5G.
5G.
Remember when 5G was going to be that was almost the AI, it felt like, several years ago.
And it never produced.
And it's out there. It's 5G's out there. It's been deployed. I think John's data was like, half of the U.S. network has viable 5G, and its impact, you can get your stuff down faster, your stuff downloaded faster. But at the end of the day, from an investment perspective,
it didn't really do
nothing.
anything, a bit of a dud.
Yeah.
My sense is, and again, this is not my area of expertise, but just based on what I read and report and seeing a stock like NVIDIA act that way, up 241% in 1 year, suggests to me that there's some reality to it, that it's not going to be quite the dud. And speaking of 5G, how ugly are those towers? That along the highways. I mean, it's a necessary.
You gotta have them. You gotta have them.
I don't mind them. I
You
want
don't
a
mind
faster
them. Oh, so
connection.
I'm in the
I
minority
want a
here, too.
faster connection.
Yeah,
I'll take it.
When you don't have a connection, you really worry about it. Abigail Doolittle, thanks so much for joining us, Markets Reporter. Want to get to the latest on former President Donald Trump. We welcome Caroline Frederickson, Distinguished Visiting Professor at Georgetown Law. Caroline, can you encapsulate for us, summarize for us, what you think the risk is here to former President Trump from this ruling from the Colorado Supreme Court taking Mr. Trump off the ballot?
The risk obviously is not so great for him in terms of winning Colorado in the general election, because that wasn't really destined to happen in any case. There hasn't been a Republican who won that state since 2004. But nonetheless, it sets a precedent for the other states, and there will be, no doubt, a number of other states deciding the same issue about whether or not Trump can appear on the ballot. And for those in those states where there's actually a viable race, which is most states in the country, you will actually have a significant effect. Because if other states are going to rule that Trump can't be on the ballot, and we have a situation where it's obviously a very closely divided electorate, it could be the difference whether he wins or loses.
How do you see this situation faring out in the Supreme Court?
Well, it's really hard to say. This is a completely novel question. This has never gotten to the Supreme Court, even involving someone of a lower level, let alone a presidential candidate and former president. So I think it's quite complex because the issues have never been addressed. There have been some lengthy dueling law review articles trying to explain the meaning of the provision. It's the insurrectionist clause in the 14th Amendment, Section 3. The vast bulk of scholarly opinion is that President Trump is squarely within the sights of that provision. But there are those questions are open, and we can only think that the Supreme Court is going to have to approach them anew.
Are there other states that you're aware of that are maybe in advanced stages of doing something similar to what Colorado did?
Well, there is an appeal from a ruling that kept Donald Trump on the ballot that is going up, I believe, in Michigan to their Supreme Court. So that one could pose a problem for him. Michigan is a fierce battleground state. So and I think that the advocates and the voters who've been bringing these cases are surely looking at every opportunity now to make to use the Colorado ruling as a precedent, because it was very thorough, it was very thoughtful. So it will be weighed very carefully by other state courts.
Can we backtrack for a second? What does it actually mean that Trump is not on the ballot?
Well, it will be an empty line, I suppose. I mean, they haven't printed the ballots. This is still for the primary in Colorado. And it will mean that the other Republican candidates will be listed and Donald Trump will not.
This is only for the primary, or he can't appear in any election for public office?
It will be any election. Right now, it's just the primary. And the court itself, the Colorado Supreme Court, has held its opinion until early January because it's very possible the Supreme Court will decide whether to take an appeal and will rule very quickly. But after January 4, it will go forward.
Caroline, what is the real legal argument that if it gets to the Supreme Court, or maybe put just simply, what did the state of Colorado court find? That A, he was an insurrectionist, and B, the Constitution says insurrectionists can't be elected to office? I'm a little unclear as to the legal issue.
Well, so there are two elements here, and it's basically that for someone who has taken an oath to the Constitution, they cannot be an officer of the United States. So that is, Donald Trump took an oath to the Constitution when he was president, and then under the factual analysis of the trial court, he engaged in insurrection, and that judge used the January 6th report and its extensive evidence of the the ways in which former President Trump had been fanning the flames of the insurrection to find that he had engaged in insurrection. But that judge on the legal question, which is Donald Trump, is the president one of those officers that is barred from being a candidate? It seems pretty clear, I think, to most people that the president is an officer of the United States. But that's the legal question.
All right, if we step out kind of and look at former President Donald Trump's legal issues en masse, where is the greatest risk, do you think, to him, I guess, as it relates to the election, not personally, I guess, but just in terms of his ability to run and potentially, be elected?
Well, I really think the actually biggest risks to him are the other cases. I mean, it's certainly an important finding that he engaged in insurrection. Really just taking up what the January 6th Commission had already done. But I think the other cases, the Georgia case involving election interference, and the case in D.C. involving January 6th and election interference, I think those are the ones that are really could well bite him, because even the kind of the most hardcore MAGA voters may start to question their candidate if there's a rock solid criminal case against him and it's moving forward and he's losing.
And just one final question here, Caroline. Does he get good representation? I mean, it just seems like I don't know any of the firms that he hires these various things. They're not firms I've ever heard of. And do you think he gets quality representation?
Well, I think just ask Rudy Giuliani how he's doing. I think he's got some big bills right now, and I don't see Donald Trump stepping in to pay them. So, I think, one of the problems is the kind of relationships he's had with lawyers over the years haven't really meant that those lawyers have been able to succeed in their businesses. So I think a lot of very more serious, reputable lawyers have stepped away. It's a dangerous place to go.
Interesting. All right. Well, there's a lot to follow there. Caroline Frederickson, thank you so much for joining us. Caroline Frederickson, she's a distinguished visiting professor at Georgetown Law, kind of breaking down some of the legal issues surrounding former President Donald Trump in Colorado, where the state has removed him, at least at this stage, from the ballot for the upcoming primary. So another issue for the former president to deal with from a legal perspective. And it's tough to keep track of.
He's got a lot of them.
You need like a bingo card to kind of keep track of everything. Looking at the markets here, not much movement on the S&P and the Dow, pretty much unchanged on the day. A little bit upward bias on the Nasdaq, up almost 0.3%. The Russell up 0.7%. So continuing that broadening out of participation for some of these stocks to the smaller stocks. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Hey there, Paul. A pharmacy chain is getting reprimanded for the way it used its surveillance system. Bloomberg's Joan Doniger has those details.
The Federal Trade Commission is barring Rite Aid from using facial recognition for the next 5 years. That's part of a privacy settlement. The FTC says the pharmacy chain misused the technology to mistakenly tag people as shoplifters.
Now, the FTC says the improper matches often involve blacks, Latinos, or women. Rite Aid is down about 0.8%. Sirius XM Radio is being sued by the state of New York for making it difficult for customers to cancel subscriptions to its online radio services. Now, the probe by the Attorney General's office said the company trains employees to keep customers on the phone and did not take no for an answer. Right now, Sirius shares are down about 1%. And 2 food delivery companies are in legal trouble for the technology they use in their apps. Bloomberg's Gina Cervetti has that story.
DoorDash and Grubhub are being sued by a company that alleges patent infringement involving technology that allows customers to order items based on their geographic location. The suit was filed by Wireless Works IP in Texas. The delivery companies did not immediately respond to requests for comment.
And DoorDash right now is down about 0.5%. And Apple is having some technology issues of its own. The company is reporting that its online financial services are not working for some customers. Now, according to its system status page, Apple's Card, Cash Pay, and Wallet, they are experiencing outages. Apple is looking into the problem. I really hope they figure it out before I hit the subway later. Apple shares right now, they're up about 0.2%. I'm Lisa Mateo. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
We're coming up to 11:22 on Wall Street. I'm Nathan Hager. We'll start off with this red headline that just crossed the Bloomberg terminal. Paramount Global is in talks to sell its Black Entertainment Television network to an investor group led by BET's CEO, Scott Mills, as well as former Blackstone exec Chin Chu, who now runs CC Capital Partners. Sources tell Bloomberg News a price a little under $2 billion has been discussed for BET. Paramount Global shares, right now, they are higher by 2.2%. The broader market struggling to hold on to some gains. We check the markets all day long here on Bloomberg. Right now, the S&P 500 is up about 5 points, or 1/10%. The Dow Jones Industrial Average is little changed, up 12 points, and the NASDAQ Composite up 50 points. That's a gain of about 1/3%. 10-year Treasury up 5/32. So bonds are paring back some of their gains this morning. The 10-year yield is at 3.91%. The 2-year at 4.38. NYMEX crude's up 1.5%, up $1.12. $75.05 for a barrel of West Texas Intermediate. COMEX gold is down 0.2% at $2,048.20 per ounce. The euro is at 1.0973 against the dollar. The yen, 143.71. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Emily Grafeo.
Nathan Hager, thank you so much for that. We appreciate it. Emily Grafeo, Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio, and we're also streaming on YouTube, so check that out. I mean, I look at the 10-year, 3.91%. It was at 5% just like 5 or 6 weeks ago. I'm an equity guy, so what do I know? But that seems like a big move in a short period of time. I'm going to ask somebody who actually does this stuff for a living. Lisa Hornby, head of U.S. multi-sector fixed income at Schroders, and she is a proud graduate of the State University of New Jersey, the Rutgers Scarlet Knights. So we love having the Scarlet Knights on here. Lisa, thanks so much for joining us here. What do you make of that move in the bond market, the 10-year? I mean, I guess the Fed winked at the market, and that's all the market needed?
I mean, when you were making your initial comments that you're surprised by it, and you want to ask somebody who does this for a living, I was thinking, I'm surprised by the magnitude of the move as well.
Yeah.
You know, I think the Fed really delivered a more dovish message than I would have expected them to, just because they could have just let things roll without effectively committing to a series of rate cuts next year. But that obviously gave the market the green light that, hey, the Fed's not going to be in the way anymore. Hikes are off the table. We're now moving, we're actually moved from there may be a hike left to we're on pause to actually we're thinking about cuts now, which was a surprise if you followed what Powell said only a few weeks earlier, which said we're not ready for cuts yet. We're not there yet. So it was a very, very dovish response, and I think some of the central bankers, more recently, not all of them, but a couple have come out and walked it back a bit because we've had a massive easing in financial conditions as a result. So the magnitude of the move is extraordinary. I think as you said, I think it's solely down to the fact that the Fed has basically said, look, we're not going to get in the way. So have at it.
Yep.
I was at your Outlook event, Lisa, a few weeks ago. It was before Powell's dovish pivot. So I'm wondering, have you had to change your 2024 outlook or any calls or expectations for the year post Powell?
Well, from that event, we were pretty bullish on interest rates at the time. 5% yields. I mean, we think fixed income still offers incredible value, but 6 weeks ago it offered even better value. So we got maybe more of the move than we expected. Longer term, we still think bonds look attractive. We like the higher quality elements of the market now, just given how much spreads have compressed. So we're looking at things like agency mortgages in a big way, some of the shorter dated ABS, that's very highly collateralized. We think that those parts of the market maybe offer a little bit more value than some of the riskier segments, just given the magnitude of this rally. But I suppose the other part of it is the Fed, in some ways, although they've backed away from hikes and taken some risk off the table, they do leave us in a somewhat precarious position because if, let's just say, we do get some inflation prints that surprise to the upside, that's not our base case, but it's not impossible. It just happened in Canada. that means that the Fed is potentially going to reverse some of this. And so we are in a situation now where we could see some volatility next year if things don't play out exactly the way the market is pricing in. And it does feel like there's a lot of, sort of price to perfection element going on here in financial markets across the board, not just on the fixed income side.
So, Lisa, I'm looking at typing in the IN-GO function on the Bloomberg terminal. It gives me the Bloomberg Index browser. U.S. fixed income, it's in the green everywhere across the board, and that's different from just a few months ago. So a big rally here for the return in fixed income led by high yield up 12.5%. Where do we go in 2024? Do I stick with my high yield call here?
From a yield perspective, high yield still doesn't look bad. From a spread perspective, we're a little bit more skeptical on it. So I represent a sector team at Schroders, and our view is that we'll probably have a better opportunity from a spread perspective to allocate to high yield. That doesn't mean there aren't some idiosyncratic opportunities at the moment. There certainly are, but from an all-in sort of spread perspective, we are a bit more cautious. I mean, again, the rally has been significant. We are looking for a slowing economy in 2024, some loss of momentum on the consumer side. We're already seeing some evidence of that. And there could be a more difficult situation as the refinancing walls, the reality of the refinancing walls start to hit. Those are not for another year or two on the high yield space, but there are going to be issuers that do have to refinance at significantly higher rates, even with this rally. And if we do see earnings start to turn down a bit, that could be a more precarious position. And again, you still have the Fed who, although this week they feel that they're going to be cutting 3 times, that could change if we get some data that maybe surprises a bit. So for us on the yield side, high yield looks good. Total returns from this increase are generally fairly positive. From a spread perspective, we think we'll see better opportunity to invest in that space.
What about government bonds? What's your favorite part of the Treasury curve to invest in right now?
I mean, we are focused on the intermediate part of the curve, probably 5 to 10 year. We do think curves likely steepen. We would say that they probably bull steepen longer term. So we see rates come down across the curve. They come down probably a bit more at the front end. Again, this is looking 12 months out. A good bit of that has now been discounted. So, we're thinking about how much more things can go. But I guess the reality is when the Fed does actually enter a rate cutting cycle, they typically cut rates by 250 basis points. The market's currently discounting about 150. So there could be some more room there. I think our view is that they probably don't start cutting quite as soon as the market is now anticipating. It might be the back half of 24.
So, Lisa, how do you think the market views this Federal Reserve these days? I mean, I think the call was, boy, they were slow, really behind the curve, slow to kind of recognize inflation, slow to react. But I guess when they did react, they reacted pretty aggressively. But how do you think the market views the Fed here?
Well, right now, I think the market views the Fed as Santa Claus giving the best gift that they could have given in December. But more broadly, look, it's been a tough road for them, for all of us. This inflation was transitory, and then it was not transitory, and basically the Fed's view for the almost entirety of 2022 was we're going to fight inflation no matter what else happens. And that was bad for basically every asset class outside of cash, and a couple of select other ones. But it wasn't a great environment for anyone. And, now we moved into 2023. And as you said earlier, outside of high yield and again, cash, most total returns in fixed income were negative through, I guess it was October. And then, we got this massive rally thanks to, some Fed comments and a couple of other things that happened over the course of the last 6 weeks. And things are rather positive again. Yep. So, I don't know. How do we judge the Fed? Well, they are, like us, responding to what they see. So they're data dependent, and they've missed some and they've gotten some, but I guess we're grateful for a December rally.
December rally, very, very pronounced rally here. Lisa Hornby, thanks so much for joining us. Lisa Hornby, she's head of U.S. multi-sector fixed income at Schroders. And, talking about rates, we talk about the 10-year. How about the 30-year mortgage? I use MB as in boy 30, and that gives you the MBA U.S. 30-year contract rate, 6.83% on a 30-year mortgage, and that's high relative to the standards over the last 10 to 12 years. But if you go back to October of 2023, so just a couple of months ago, that was 7.9%. That's where it peaked. So it's really come down more than 100 basis points. And then I guess for those kind of looking to buy a house, that's welcome news. Are you looking to buy a house?
I'm not.
Okay.
I don't know if mortgage rates go down even further. I don't know if I'll be looking.
I think
not yet.
I think they're going to go down more. I hope so. Like I bought my Jersey Shore palatial estate compound back in March, and I paid a 6% mortgage, and I thought that was just the worst deal ever. But then it went up to 7.9%. I said, hey, maybe it's not so bad.
You
I'm
locked it in.
A real estate mogul. I am. But here it's coming back, and I hope to, like a lot of people, hope to refinance. But these numbers are just staggering. 80% of the mortgages out there are 5% or below, and or 90%. I think 80% or 4% below. So it's just amazing. The rates that people have locked in.
Right.
The net result is, if you're sitting on a house, you don't want to sell it, because then if you can go buy something else, much higher rate. So
that idea of Fed policy, the transmission mechanism,
Yep.
not really kicking in yet because of that.
Yeah, exactly. So we'll see. I wonder what the clearing rate is for people to say, all right, I'll sell, and I can take this little bit higher rate here. So we'll stay on top of that. Mortgage rate, 6.83%. Right now, let's get our news, and we're going to go to Scott Carr, I believe.
Indeed. Good
Boom.
morning.
Nailed it.
The U.S. is set to release an ally of Venezuelan President Nicolas Maduro, Alex Saab. That's in exchange for a number of Americans being held in that country. It's the latest step in a broad diplomatic push that also involves limited sanctions relief for Venezuela and progress toward democratic elections there. Persons familiar tell Bloomberg it's expected Saab will be released today for about 10 Americans, including Luke Denman and Aaron Berry, two former Green Berets who were jailed on terrorism charges and over a failed 2020 plot to try and overthrow Maduro. Defense Secretary Lloyd Austin made a surprise visit to the USS Gerald R. Ford aircraft carrier earlier today. To meet with the sailors, he's ordered to remain at sea with the goal of preventing the Israel-Hamas war from escalating. The secretary told the sailors aboard their work there is important.
Sometimes our greatest achievements are the bad things that we stop from happening. And at a moment of huge tension in the region, you all have been the linchpin to preventing a wider regional conflict.
Secretary Austin's been there to press Israel to shift its bombardment of Gaza to a more limited campaign. Reports say there's been concern among some U.S. officials that Israel may launch an offensive against its northern border with Lebanon in an effort to expel Hezbollah militants, potentially opening up a second front to the conflict. Former President Donald Trump is reacting to the Colorado Supreme Court's decision to ban him from that state's 2024 presidential ballot. The Colorado Supreme Court said yesterday he violated the 14th Amendment's insurrectionist ban on January 6, 2021, when he encouraged violent demonstrations at